Hello Kanna, I welcome you all to the much awaited, much anticipated and very powerful revision lecture on profit and gains of business or profession for CA Intermediate Direct Tax paper for May 26, September 26 and Jan 27 examination. But before beginning, as usual, my humble request to you is to please like this video, please fill the comment section with some motivating, encouraging comments and also subscribe the channel so that you never miss an update. Moreover, if you find a button called hype button below this video, please make sure to click that button and give me some points so that this video reaches a newer audience as well. Now, without further ado, let us begin the revision of profit and gains from business or profession. This PGBP head of income is the biggest head of income, also the largest chapter in your CA Intermediate Direct Tax syllabus, but not to worry at all. It is more or less concept based, very little of memory, and definitely if you watch this video till the very end, at least 2 or 3 times you have to watch this revision lecture. 100% you are not going to miss even a single adjustment in the examination and you are going to score full marks. You know that total income question that you get in your examination, which is the first question for 15 marks, the major adjustments are going to come from this chapter only. So you have to be well prepared from this chapter. Minimum 10 marks is going to come from PGBP head of income, and it is very simple if you watch this lecture. Fine. So let us begin the PGBP head of income. Firstly, introduction to PGBP. First, what is business? What is profession? Let us quickly see. Section 2 clause 13 defines business, that business includes trade, commerce or manufacture or any adventure or concern in the nature of trade, commerce or manufacture. So trade relates to buying and selling, commerce means providing service, or manufacturing means production of goods or manufacturing of goods. So if you do it regularly, then also it is included in business. If you do once in a while also, then also it is included in business. Then what about profession? Section 2 clause 36 defines profession. It means an occupation requiring some degree of learning. It also includes vocation. Vocation means any work which requires some special knowledge. So whatever requires special knowledge, it is called profession. Now let us talk about concept of profit in the PGBP head of income. Profit can be in cash or in kind. So you can receive in money form also, or you can receive in kind form also. Both will be considered as profit. Then profit includes capital receipts only if it is specifically provided. So capital receipts will be taxable in PGBP only if it is specifically provided under the Act. It includes voluntary receipt in the course of business or profession. So if I am doing profession, okay, I am doing teaching profession, maybe you did not take my coaching and you did not pay me the fees, but you saw this revision lecture and you scored all India top marks in direct tax paper, and you are so happy that because of me you are scoring the high marks. So you gave me one gold chain as a gift. Okay, wow. So this gold chain has come because of teaching only, no? That is why it will be taxable for me in PGBP head of income. So even though you have not taken my direct tax batch, still from my direct tax lectures only you have given me a gold chain. That is why it will be taxable under PGBP head of income. Then applications of gains is immaterial. So it does not matter where I am spending the PGBP money. So business and profession income, whatever I am getting, it does not matter where I am spending. For example, a customer was there. Customer was giving me the money. Instead of giving me, I asked the customer that you please donate this money to charity. Does it mean that it is not my profit? Answer is it will be considered as my income only, because applications of gains is immaterial. Then income can be legal also, illegal also. So if I am doing money laundering, if I am doing smuggling, kidnapping, murder, for that if I am earning any money, that money is also taxable under PGBP head of income if doing all these activities is my business. Okay, but it is not my business, don't worry. Next, PGBP is the aggregate of profit of all the businesses. So Kanna, some people get a confusion. Sir, only main business will be considered as business, all the other side business will be considered as other sources. But that is not the case. All the business will be covered under profit and gains of business or profession only. Fine. So if there are multiple businesses of a assessee, then take the profit of all the businesses separately, add them together, you will find the total PGBP income. Then profit is the net profit, not the gross receipts. So the sales is not taxable under PGBP, net profit is only taxable under PGBP. But net profit does not mean net profit as per books of accounts, it means net profit as per the Income Tax Act. So this is the concept of PGBP. Now let us come to section 28, which is the charging section. Every head of income has a charging section and a computation section. In PGBP head of income, 28 is the charging section, 29 is the computation section. So what does the charging section say? first line itself covers all the business and profession. That is, income from business or profession is taxable under profit and gains of business or profession. So first line itself covers everything. Now what and all we are going to study are some extra points only, which is also covered under PGBP head of income. So let us see one by one. However, if an assessee is engaged in the business of letting out of residential houses, such income shall not be chargeable under PGBP head of income. Kana, while discussing the house property head of income, I already told you that if the assessee is having the business of giving the house property on rent, and if the house property is a residential property, it will be taxable under house property head of income. If the house property is a commercial property, it will be taxable under PGBP head of income. Then any compensation or any other payment due to or received by a person managing the affairs of an Indian company or Indian affairs of a foreign company. So if I am managing the affairs of an Indian company and getting the money, then it is taxable under PGBP head of income. For example, in insolvency and bankruptcy code, I became the resolution professional and getting the money from the company. So it is taxable under PGBP. Then by any agent or for termination of agency. So if I am doing any work on behalf of another person, that is doing agency, it is also taxable under PGBP. Or if the person is terminating my agency and giving me the money, that is also taxable under PGBP. Then if I am doing any government contracts and government is giving me money, that is also taxable under PGBP. And lastly, any person for termination or modification of business terms. So I am having any business terms or contract, there is change in that contract, because of that change I am receiving any money, that is also taxable under PGBP head of income. Then income of trade, professional or commercial association by giving service to its members. So trade, professional, commercial association, whenever they are giving services to its member, then the money received by them is taxable under PGBP head of income. Then export incentives. All these export incentives and all are covered in your CA final syllabus, Kanna, not there in CA intermediate. But this much you know, if at all these words are coming in the question, it means it will be covered under PGBP head of income. Fine. So what are they? Profit on sale of import entitlement, profit on sale of duty entitlement passbook scheme, profit on sale of duty free replenishment certificate, cash assistance against exports, and duty drawbacks. So all these will be taxable under PGBP head of income. Then any benefit or perquisite related to business in cash or in kind or partly cash partly kind will also be taxable under PGBP. For example, I am a dealer of a company. Now that company is very happy with me, so they are giving me a foreign trip. This is also taxable under PGBP. They are giving me a gold coin. This is also taxable under PGBP. All the gifts, whatever I am receiving in course of my business, will be taxable under PGBP. Moreover, you know, when the company is giving me the foreign trip, no, that time if the trip value is more than 20,000, that is during the entire year, if the benefit is more than 20,000, they will also deduct TDS for me under section 194R. This you will be learning in TDS chapter. Okay, wow. Then sum due to or received by any partner or partnership firm. In salary chapter revision itself, I told you, partner means what? Part owner. That is why whatever money is received by a partner of a partnership firm, in such case it is always taxable under PGBP head of income. Then sum received for not carrying out any activity. So if I am not doing any activity, for that if I am getting any money, then it is taxable under PGBP head of income. Then sum received under key man insurance policy. Okay, before point I did not discuss. No, sum received for not sharing any know-how, patent, copyright, trademark, license or franchisee. So for not sharing my intangible asset, if someone is giving me money, that is also taxable under PGBP. Then sum received under key man insurance policy. Key man insurance policy, I already told you, when the employer is receiving the money from the company, insurance company, it is taxable under PGBP head of income. When the employee is receiving the money from insurance company, it is taxable under salary head of income. When a person other than employer or employee is receiving the money, it is taxable under income from other sources head of income. Okay. Then when inventory is converted into capital asset, okay, stock converted into capital asset, that is also taxable. So fair market value of the inventory will be considered as income under PGBP. Fine. Then sum received from the transfer of capital asset on which deduction has been claimed under 35AD. So 35AD deduction, if you are claiming on a capital asset, whenever you sell this capital asset, whatever money is coming will be fully taxable under PGBP head of income. 35AD we are going to discuss in this video only. It talks about specified businesses. Okay, wow. Now let's come to section 45, method of accounting. Before beginning the computation, 2 or 3 concepts let me quickly discuss so that you are clear in your mindset. So first let us talk about method of accounting, section number 145. assessee can follow either cash system of accounting or mercantile system of accounting. Karna, for salary head of income, for house property head of income, and for capital gain, it is very clear how you are going to tax the income. That is why method of accounting is not required. However, in profit and gains of business or profession, and also in income from other sources, in these two heads of income, many different types of incomes are taxable. That is why it is very important to have a standard method of accounting. The Income Tax Act allows both method of accounting, that is cash system also, mercantile system also. Cash system means payment basis of accounting, a mercantile system means accrual basis of accounting. So one time if you start one method of accounting, then year on year you have to continue with the same system of accounting. Unless there is a very specific reason and you want to change, then you can intimate to the assessing officer and change the method of accounting also. Fine. Then exception to method of accounting, that there are two cases Kana where you should not at all see the method of accounting. Always the income is going to be taxable on receipt basis. You should not see the method of accounting. What are they? Number one, interest on compensation or enhanced compensation received on compulsory acquisition. So when the government is compulsory acquiring your property, the government will give you compensation. On that compensation, if they are paying late, they will give you some interest on compensation. This interest on compensation is always taxable on receipt basis. Always taxable on receipt basis. Then subsidy, incentive, etc. received from any government or others. So if any subsidy or incentive is received, that is also always taxable on receipt basis. Fine. Then all the assessees have to compulsorily follow ICDS, that is Income Computation and Disclosure Standards. So this ICDS is nothing but the accounting standards you are studying now in accountancy. Similarly in direct tax, it is Income Computation and Disclosure Standards, okay, for showing the income. So it is compulsory, but don't worry, it is a part of CA final syllabus. Now if you know that it is compulsory to follow, that is enough, okay. However, there are two exceptions to ICDS. Two types of people need not follow ICDS. Who are they? Number one, individual or HUF who are not required to get their books of accounts audited under section 44AB, and number two, assessees who is following the cash system of accounting. So in both cases, no need to follow ICDS. All the other persons have to compulsorily follow ICDS. So this is method of accounting. Now let us come to section 44AA, compulsory maintenance of books of accounts. So who has to compulsory maintain the books of accounts? Let us see. First and foremost, where should the books of accounts be maintained, Kanna? What is the place to maintain books of accounts? Answer is principal place of business. So books of accounts always have to be maintained at principal place of business. Then what is the time period to maintain this books of accounts? So time period is 6 years from the end of the assessment year. So 6 years from the end of the assessment year, till that you have to maintain the books of accounts. So what and all books of accounts you have to maintain? The previous year you have to maintain, then assessment year you have to maintain, then 6 years you have to maintain. So totally, including current year, if you see, 8 years you have to maintain. Previous year plus assessment year plus 6 years after the assessment year. Fine. Now what are the books of accounts to be maintained? Very simple. Okay, the Income Tax Act does not tell anything. It gives only a simple definition. Just maintain such books of accounts that will enable the assessing officer to compute your income. So assessing officer should be able to see the books of accounts and should be able to calculate what is your income. That is only the books of accounts that you have to maintain. So such books that may enable the assessing officer to compute the total income. Now let us see who has to compulsorily maintain the books of accounts. First, let us see section 44AA subsection 1. 44AA subsection 1 talks about prescribed professionals, Kanna. These prescribed professionals have to compulsorily maintain their books of accounts, and moreover, this 44AA definition is going to come in other places also, so you have to be thorough with the definition. It comes in presumptive income section 44 ADA, and it also comes in TDS section 194J. All that it will be tested. So you should know who are these prescribed professionals. Who are they? The professionals are legal professional, medical, engineering, architecture, accountancy, technical consultancy, authorized representative, interior decoration, film artist, company secretary, and information technology professional. And here film artist includes actor, cameraman, director, music director, art director, editor, singer, lyricist, story writer, screenplay writer, dialogue writer, and dress designer. So all these are prescribed professionals. So these prescribed professionals should compulsorily maintain the books of accounts. What books of accounts are? Such books of accounts which will enable the assessing officer to calculate their total income. Sir, should I memorize all these names? Answer is not required. You just read them 2-3 times, then automatically it will get installed in your brain. When you see it in the question, you will be able to identify. Don't worry. Now let's come to section 44AA subsection 2. Other than these prescribed professionals, who should compulsorily maintain the books of accounts? First, let us talk about individual or HUF. In case of individual or HUF, if at all their income is more than 2,50,000 or turnover is more than 25 lakhs in any of the 3 preceding previous years. So before the previous year, you have to see the 3 years. In any of the 3 preceding previous year, if income is more than 2,50,000 or turnover is more than 25 lakhs. So any one condition need to be satisfied in any one of the years also. If it is satisfied, then maintenance of books of accounts is compulsory. Okay. So income greater than 2,50,000 or turnover greater than 25 lakhs, then they have to maintain the books of accounts. Sir, what if in this year only the business has started, in the previous year, then what to do? Then in case of the new business or profession, if the income is likely to exceed 2,50,000 or turnover is likely to exceed 25 lakhs during the previous year, then such individual or HUF has to compulsorily maintain the books of accounts. Then let's talk about other than individual or HUF. In case of other than individual or HUF, if the income is greater than 1,20,000 or turnover is greater than 10 lakh rupees in any of the 3 preceding previous years, then they have to compulsorily maintain books of accounts. And in case of new business or profession, if income is likely to exceed 1,20,000 or turnover is likely to exceed 10 lakh rupees during the previous year, they have to compulsorily maintain books of accounts. And other than these, if at all, for a person to whom section 44 ADA or section 44 AE or section 44 AD is applicable. So what are they? These are nothing but presumptive income section karna, which we are going to learn in this lecture only. So presumptive income, if it is applicable and if the assessee is showing the profit lower than presumptive income, then such assessee has to compulsorily maintain books of accounts. So 44 AD, 44 AE and 44 AD. All these 3 cases, if profit is shown as lower than presumptive income, compulsory to maintain books of accounts. Moreover, in 44 AD, if at all you are coming out of 44 AD within 6 years, then for the next 5 years also compulsorily you have to maintain books of accounts. So 5 years after the previous year in which the income is shown less than the presumptive income, for that also you have to compulsorily maintain books of accounts. So current previous year also, after that next 5 years also. So total 6 years karna, previous year plus next 5 years. Fine. Now let's talk about rule 6F. Prescribed professional should maintain prescribed books of accounts. Sir, you already told all the professionals have to maintain books of accounts. Now again you are telling prescribed professionals have to maintain books of accounts. Sir, what is the difference? Answer, the difference is all the professionals have to maintain such books of accounts which will enable the assessing officer to compute the total income. However, prescribed professionals, know that we are going to study now, they have to maintain prescribed books of accounts. What are these prescribed books? Prescribed books means cash book, journal, ledger, bills, that is sale bill more than 25 rupees and expense bills or purchase bill more than 50 rupees. What did I say? Cash book, journal, ledger, sale bill more than 25 rupees, expense bill or purchase bill more than 50 rupees. They have to maintain. Who has to maintain, sir? Prescribed professional. Who are prescribed professional? For a professional, if the gross receipt exceed 1,50,000 in all the 3 preceding previous years, or if it is a new profession likely to exceed 1,50,000, then such professional will be called as prescribed professional. So here there is a fundamental difference. First, where we studied about individual HUF and others, we saw any of the 3 preceding previous years. However, in case of prescribed professional, the condition is all the 3 preceding previous years. So here you should not make a silly mistake. In all the 3 preceding previous years, if the income is more than, gross receipts is more than 1,50,000, then such professional have to maintain books of accounts. In case of new profession, if it is likely to exceed 1,50,000, then the professional has to maintain prescribed books of accounts. Prescribed books of accounts means cash book, journal, ledger, sale bill more than 25 rupees, expense bill more than 50 rupees. And if the professional is a medical professional, then the medical professional should also maintain a daily case register in form 3C and also inventory of medicine on the first day and last day of previous year. So these are the provisions for maintenance of books of accounts. Now let's talk about exemption under section 10 clause 2a. So 10 clause 2a tells that the share income received by a partner is exempt from income tax. So share income of a partner of a partnership firm or limited liability partnership as per profit sharing ratio is exempt. Even if the income was exempt in the hands of partnership firm, still it will be exempt in the hands of partner. So partnership firm is paying the tax, no. Now the taxed income is only shared with the partner. That is why when the partner is receiving the share income, it is tax free. No need to pay the tax. Now let us talk about section 29, that is computation section. Computation section in PGBP is very simple. It is just telling you follow section 30 to section 43D. You just follow section 30 to section 43D. Automatically you will be able to compute business income. Now let us start from section number 30. But before beginning the computation provisions, first and foremost, I would like you to come to the last page of this chapter in your book. And in last page, I want you to write something. First, what you have to do, first you please pause the video, okay, and make note of whatever I have given on the screen. In the screen is not visible. Okay, now pause the video and first write down this part. Fine. Then you unpause the video, pause the video once again and write down this part in the 1 page space that I have given you after the PGBP chapter. Fine. Completed. Now let me explain you quickly. Karna, when you come to your examination, in examination you can either get a total income question or you can get a comprehensive PGBP question. Both type of question can come in two types of method, Karna. One is direct method and the other is indirect method. In direct method you will be directly getting all the adjustments, and based on the adjustment you have to calculate the PGBP head of income, or you can also get receipts and payment account, or you can get cash and bank account, whatever it is you might get in the direct method. However, in indirect method you can either get income and expenditure account or you can get profit and loss account. So in both cases it is the indirect method, and you know what, frequently only indirect method is being asked in the examination. That is why you have to be thorough with the indirect method. What I see, that the students are knowing all the provisions, but just because they are not comfortable with the indirect method, in spite of knowing the provision, they are making mistake in the examination and losing the marks. So if you study and in spite of studying if you are losing the marks, then it will cause a pain in my heart. Obviously in your heart also, that in spite of studying you are not able to score the marks. So to avoid that silly mistake, listen to me carefully. Next 4-5 minutes, very important for you, so that you don't make a mistake. And before entering the exam hall also, last moment, I want you to see this table and then only go into the examination hall. Fine. Now let us imagine that this is a profit and loss account of a business. In profit and loss account, there will be many expenses in the expense side and incomes in the income side. Both you have to see, and net profit will be given. Finally, there will be some other adjustment which is outside the profit and loss account. Now on this net profit is there, here already while calculating the net profit, certain incomes have been added and certain expenses have been reduced. Correct? Then only net profit is calculated. In indirect method, you have to indirectly calculate the PGBP income, which means what? You have to take the net profit as the base and you have to do the reverse working to find out what is the PGBP income. So now let me tell you how to do the reverse working. First, what you have to take? You have to take the net profit as per the books of accounts, which is 65,000 in this case, 65,000. Then you have to see all the adjustments one by one. First you have to do all the addition adjustment, then you have to do all the deletion, that is subtraction adjustment. Here I am doing in mixture itself so that you are aware how to do the adjustment. So first and foremost, let us see. In the P&L account, there is an income of 70,000, but it is given that as per Income Tax Act, it is an exempt income. So it means what? While calculating the net profit, you have added the income. But now in Income Tax Act, that income is not taxable. So now what you have to do? Now from the net profit, you have to reduce that income. So exempt income have to be reduced. So 70,000 you will reduce from the net profit so that you are getting the PGBP income. Fine. Now let's talk about second adjustment number B. Adjustment number B is a taxable income of 50,000. So as per profit and loss account, it is shown in the income side. As per income tax also, it is a taxable income. So that is why what you should do, you should not do anything Kanna. You should just ignore it, because while calculating the net profit itself, this income has been added. So now since the income is already added, you need not do anything. That is why you should ignore this income. So taxable income of 50,000, since it is already included in the net profit, we need not do anything. We will just ignore it. Next adjustment. As per profit and loss account, the income is 20,000, but as per Income Tax Act, the income is actually 25,000. So now what to do? Kanna, while calculating the net profit, already 20,000 has been added. That is why you have to add only the balance 5,000 rupees. So 25,000 minus 20,000, which is 5,000, should be added in the PGBP head of income, added to the net profit to find out PGBP head of income. Next, 30,000 is the income as per profit and loss account, but however, as per Income Tax Act, only 10,000 is taxable. Entire 30,000 not taxable, only 10,000 is taxable. Then what you will do? Since while calculating the net profit, you have included 30,000, but you have to include only 10,000. So what you will do? You will reduce 20,000. So 30,000 minus 10,000, 20,000, you have to reduce from the net profit. Okay. If you're not understanding any adjustment, you rewind the video, you see once again and try to understand, because this concept has to be clear before entering the exam hall. Okay, well, then E, there is an adjustment E, which is an income of 5,000 in the profit and loss account, but you know that it is not taxable and that the PGBP head of income, it is actually taxable in income from other sources head of income. For example, dividend income will be there. Okay, now what you will do? So since it is not taxable under PGBP, first you have to reduce it from the net profit, so that you get correct PGBP income, and then you have to go to the income from other sources, and there you have to add it in income from other sources. So double adjustment you have to do, Kanna. So this is also very important. Then let's talk about item number F. Item number F is a taxable income of 45,000, which is not at all mentioned in the profit and loss account. So now what you have to do, since while calculating the net profit, this 45,000 rupees has not been included, that is why now you have to include manually. So 45,000 you have to add to the net profit. Now let's come to the expense side. First let us talk about item number T. Item number T is an allowed expense in the Income Tax Act, but it is not shown in the expense side of the P&L account. Since it is not shown, the expense might not have been reduced, so that is why now you have to reduce this expense. So 15,000 you have to reduce from the net profit. Now let's talk about item number V. Item number V is 5,000, which is shown in the expense side of profit and loss account, but you know that it is an expense in capital gain head of income. It is not expense in PGBP head of income. So what you have to do, this expense you have to add back. Earlier it was reduced, no. Now you know that it should not be reduced. So what you will do, you will do the reverse calculation. So you have to add back to the net profit. So 5,000 you will add back to the net profit, and you will reduce it in the capital gain head of income. You get my point? Now let's talk about item number W. Item number W is 10,000, which is shown in the expense side of P&L, but as per Income Tax Act, it is not allowed as an expenditure. Okay, well, not allowed, disallowed. So what you have to do, you have to add back the amount. Then item number Y. Item number Y is 30,000 rupees in the expense side of P&L, and in Income Tax Act also it is allowed as an expenditure. So what you have to do, you need not do anything, Kanna. You have to ignore, because it is allowed in income tax. It is also reduced in profit and loss account. Since while calculating the net profit, already the amount has been reduced, the correct amount, that is why you need not do anything. Now let us talk about last adjustment. As per P&L, 40,000 is the expense. However, as per Income Tax Act, 50,000 is the expense. So now what you have to do, already 40,000 would have been reduced while calculating net profit. So further 10,000 now you reduce, so that you find out the correct PGBP profit. So 10,000 to be reduced. So after doing all this adjustment, finally whatever total you are getting will be the profit and gains from business or profession. I hope you are clear, comfortable with the indirect method. Very, very important, Kanna. Only then you will be able to solve it in the examination. Fine. Before going into the exam hall, I want you to refer this page once. Now let's come to the Now let's come to the computation provisions. First, let us start with the deductions. So what are all the different types of expenses that is allowed under PGBP head of income? Let us see. Firstly, let us talk about section 30. Section 30 tells rent, rates and taxes, repairs and insurance to building is allowed as deduction. Now what are the conditions? Let us see. First and foremost, the building should be used for business. Only if the building is used for business, then expense related to the building will be allowed as deduction. In case of partly business and partly other purpose, proportionate expense will be allowed as per section 38. So for example, in building there are two floors. One floor you are using for business, one floor you are using for personal purpose. In such case, what will happen? Only for the floor related to business you can claim the expense. The floor which is used for personal purpose, you cannot claim the expense. Then in case of sublet premises, allow net rent. Sometimes what the assessee will do, assessee will take a building on rent, and this rented building the assessee will give on rent, sublease to some other person. In such case, the assessee will be paying rent also, he will be receiving rent also. In such case, the difference of rent will be either allowed as expense or will be added to income, as the case may be. Then in case of own premises, no notional rent is allowed. So if, for example, if I am having a building, that building I am using for my own business, can I pay rent to myself and claim the deduction? Answer is no. That is not allowed as expense. In case of partner's premises, if the partnership firm or LLP is paying the rent to the partner, in that case, reasonable rent is only allowed, excess rent is not allowed. For example, if the partnership firm is paying the rent, let's say the rent amount is 1 lakh rupee per month, but the market rate is only 80,000 per month. In such case, what you will do? 80,000 is allowed, balance 20,000 is the excess rent. No, that is not allowed as deduction. Next case, capital expenditure is not allowed as deduction. So if at all there is a capital expenditure done to the building, then the capital expenditure should be added to the cost of the building, and for that cost you can claim the depreciation. So it is not allowed as deduction. Okay, well, however, tenant can also incur capital expenditure. No, tenant does not own the building, he is not the owner. But what if tenant is doing the capital expenditure? If tenant is doing the capital expenditure, then such expenditure will be deemed as building, and on such deemed building, the tenant can claim depreciation karna. Okay. Then expense is allowed to the person who is incurring the expense. So if tenant incurs the expense, tenant will get the deduction. If owner incurs the expense, owner will get the deduction, provided the building should be used for the purpose of business. Now let's talk about section number 30, repairs and insurance of machinery, plant and furniture. So first we were talking about building, now we are talking about plant and machinery and furniture. So for plant and machinery, repairs and insurance is allowed under section 31. Here also there are some conditions. What is the condition? The asset must be used for the purpose of business. So it should be used for business. Even passive use is allowed karna. So what is passive use? Passive use means not actively being used in business, but still it will be considered as usage. For example, you are having a machinery, 10 machines are there. Just in case if any machine gets repaired, you are having one extra standby machinery. So the standby machinery, even though it is not being used, still it will be considered as passive use. For example, you purchased one generator. This generator you have kept so that if at all there is no power, then you can use the generator for power. However, if the generator is not being used at all, still it will be considered as passive use, because you have kept it so that in case of emergency you can use it. Then let's say you are having fire extinguisher. That fire extinguisher you have kept hanging on the wall. Just in case if there is fire, you can use that fire extinguisher. So this is also passive usage. Then you are having some tools. Just in case there is any repair, you can use the tools to do the repair work. However, if there is no repair, you will not use the tool. This type of work is also called passive use. You get my point? So even passive use is considered as usage, and expense will be allowed as deduction. Now, if the asset is used for partly business and partly some other purpose, then proportionate expense will be allowed as per section 38. Repair includes renewal and renovation, but does not include replacement or reconstruction, because replacement and reconstruction is a capital expenditure, and capital expenditure is not allowed as deduction. Then rent, rates and taxes are not covered in section 31. However, they will be allowed in section number 37. Okay. Now let's talk about the biggest section in your entire direct tax syllabus, that is section number 32, which talks about depreciation. Okay, depreciation. There are three conditions to claim depreciation under the Income Tax Act. What are the three conditions? Number 1, assessee should be the owner of the asset. Number 2, asset should be used for business or profession. Number 3, asset should be a depreciable asset. So what are the three conditions? Assessee should be owner. Number 2, asset should be used for business. Number 3, asset should be a depreciable asset. So let us go into these 3 points one by one. Firstly, talking about ownership. So ownership is allowed, the depreciation is allowed to the owner. So if at all the asset is given on rent, then who can claim the depreciation? The lessor only can claim the depreciation. Fine. Whether it is a finance lease or operating lease, whether it is a short-term lease or long-term lease, it does not matter. In both cases, the lessor only will get the depreciation. Then, if assessee is a part owner, then depreciation will be allowed only for the assessee's share of the asset. Then, building owner need not be the owner of land. Kana, for land there is no depreciation. For building only there is depreciation. So, whoever is the owner of the building can claim the depreciation on building. Then, depreciation is allowed even if owner is not the user. So for example, if I am having an asset, that asset I have given on rent, in such case I am not using the asset, my tenant is only using the asset. Still, who will get the depreciation? I only will get the depreciation. So for example, if asset is leased, rented, hired, etc., the lessor will get the depreciation. So if letting out is the business of the assessee, then depreciation can be claimed in PGBP head of income. If letting out is not the business of the assessee, then depreciation can be claimed in income from other sources head of income, but the rules will remain same. Now let's talk about assets should be used for business or profession. So here also even passive use is allowed. Kana. So fire extinguisher, tools, standby machinery, all these are passive uses. If asset is used for partly business and partly other purpose, proportionate depreciation will be allowed, and only such proportionate depreciation should be reduced from the cost of the asset. Okay. Then asset should be a depreciable asset. Kana, depreciable asset means what? The asset can be either a tangible asset or an intangible asset. In tangible asset, there are three classes. In intangible asset, it itself is a class of asset. So what did I say? Tangible asset has three classes. Intangible asset itself is a class. So total there are 4 classes. Kanna. Firstly, let us talk about intangible asset. Intangible asset is the asset that you cannot touch and feel, but it still exists. For example, know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial or rights of similar nature, but not goodwill. For goodwill, you cannot claim depreciation. For other than goodwill, only intangible assets you can claim as depreciation. So know-how, patent, copyright, trademark, license, franchisee, or any other business or commercial right of similar nature other than goodwill is included in intangible assets. So intangible asset is a class. Now talking about tangible asset. In tangible asset, there are 3 classes. So first class is building, second class is plant and machinery, third class is furniture. Building, plant and machinery, furniture. So what are the 4 classes? The 4 classes are building, plant and machinery, furniture, and intangible asset. So there are totally 4 classes of depreciable asset. Now let us speak about some special notes about depreciation. Depreciation is mandatory, Karna. It is not optional. The assessee cannot say that I don't want depreciation this year. Next year I will claim depreciation. Like that, the assessee cannot tell. Mandatorily, the assessee has to claim depreciation and reduce the WDV of the asset. Okay. No depreciation on land. Then plant includes ships, books, vehicles, scientific apparatus, surgical equipment, but does not include tea bushes, livestock, building, furniture, animals, human body, and stock. So plant includes not only plant and machinery. Other than plant and machinery, it also includes the vehicles. That is, ships also included in plant, vehicles also included in plant, aeroplane, everything included in plant and machinery. Books also included in plant and machinery. Kanna. Then scientific apparatus in the lab and surgical equipment in the hospital, that is also included in plant and machinery. But what is not included? Tea bushes not included, livestock not included, building and furniture not included. So hence you can never say that building is also plant and machinery. It will either be building or it will be plant and machinery. It cannot be both. Okay, wow. Similarly, furniture also, animals also, human body, and stock. All these are not plant and machinery. Now talking about building. Building obviously includes the permanent structure which is used for the purpose of business. Other than that also, roads are also included in building, bridge also included in building, culverts are also included. Sir, what is culvert? Culvert is nothing but tunnels kana. So tunnels also included, well also included, tube well also included in building. Then capital expenditure by the tenant also, I told you no, it is a deemed building and on that you can claim depreciation. Then goodwill of a business or profession, earlier up to previous year 1920 it was considered a depreciable asset, but from previous year 2021 onwards it is not a depreciable asset. So now for goodwill you cannot claim depreciation. Then in case of composite income, entire depreciation is deemed to be allowed. Kana, we are going to learn composite income also in this lecture only, where I am going to tell sometimes in the income there is a mixture of agriculture income as well as business income. In such case, where the income contains both agriculture as well as business, still when it comes to depreciation, it is deemed that the entire depreciation is allowed and you have to reduce the WDV of the asset by subtracting the entire depreciation. Fine. Now let's come to additional depreciation. We will discuss after depreciation. Firstly, let us talk about depreciation itself. Let us complete this discussion. So in depreciation, there are two methods kana. One is straight line method and the other is WDV method. Straight line method, WDV method. Sir, who can follow straight line method? Only the assessee who is engaged in the business of generation or generation and distribution of power. So which two business? Generation of power or generation and distribution of power. Only in such case the assessee can opt for straight line method. Straight line method. All the other assessees have to compulsorily follow WDV method. So for power generation, they have the option. They can either follow SLM or they can follow WDV. But all the others have to compulsorily follow WDV method. That is written down value method. So in straight line method, the method of calculation is a separate asset system. But in WDV method, the method of calculation is a block of asset system. Separate asset system, it means what? For each and every asset, you have to calculate the depreciation separately. But in block of the asset system, all the similar type of asset. What is meant by block? Block means same class, same rate. If any asset is in the same class and having the same rate, they should all be clubbed together to form a single block. For that block, you have to calculate the depreciation. Okay, wow. Now let's talk about depreciation formula. So in case of straight line method, it will always be cost multiplied by depreciation rate. In WDV, it will be cost, and in the second year onwards, it will be WDV multiplied by depreciation rate. Then actual cost. So actual cost we are going to discuss. It is going to be, the concept is same for both SLM method as well as WDV method. So for both of them, the cost concept is same. Talking about depreciation rate. Depreciation rate for straight line method, if at all it comes in the examination, the rate will be given in the question. So you need not by heart the rates. But WDV method, you have to learn the depreciation rates, which I am going to discuss in some time. Then additional depreciation. In case of straight line method, you cannot claim additional depreciation, but in case of WDV method only, you can claim additional depreciation in the optional tax regime. That also I am going to discuss. Then sale of assets I have discussed in the capital gain chapter, and asset purchase in between the year also I will discuss. So firstly, let me talk about actual cost and depreciation rate. Then we will come back to this discussion. Sir, what is actual cost, sir? What is actual cost? Actual cost means nothing but purchase price of an asset kana. What cost you are paying to purchase the asset, that is only actual cost. But you have to do certain adjustment to find out the actual cost. What are the adjustment? Let us see. Firstly, you should take what is the amount you have paid to purchase the capital asset. That is only cost. In that, you add the trial run expenditure, reduce the trial run income. So for example, if it is a machinery, you will do the trial run. In trial run, you will put some sample and some product will come out. That product, when you're doing putting the sample and product is coming out, whatever expense is incurred, that should be added to the cost of plant and machinery. Similarly, whenever the product is coming out, let's say you have sold that product in the market and earned some income. This income also has to be reduced from the cost of plant and machinery. So what you have to do, add the trial run expenditure, reduce the trial run income. Then whatever taxes are there on which credit is not allowed, all those taxes has to be included in the cost of the asset. For example, if you are importing any asset, you will pay custom duty. That custom duty cannot be taken as credit. That is why custom duty has to be included in the cost. Similarly, let's say there is a normal business which is not involved in buying and selling cars or any driving school. If they are purchasing any passenger car, then for that passenger car, GST input tax credit is not allowed. So for that car, input tax credit has to be added to the cost of the asset. Since they cannot take the credit, they have to add it in the cost. Okay, then interest on loan. If you have taken a loan to purchase a depreciable asset, then till the asset is put to use, whatever interest is being paid, that interest also has to be included in the cost of the asset. So interest on loan till the asset is put to use. But sir, after the asset is put to use also, let's say the loan is running, then interest is being paid. What to do about such interest? After put to use, whatever interest is being paid can be claimed as deduction under PGBP head of income, that I am going to discuss in section number 36. Okay, then subsidy received from government or any other person. So towards the plant and machinery, equipment, building, furniture, etc., whatever subsidy is received, that subsidy also has to be reduced from the cost of the asset. So for the depreciable asset, if you are receiving any subsidy, reduce it from the cost. Then lastly, payment should be made to a person in a day exceeding 10,000 in any mode other than account pay check, account pay bank draft, electronic clearing system, or any other prescribed modes. It is compulsory that if you are making any payment to a person in a day exceeding 10,000 rupee, then that payment has to be made through prescribed modes only. What are the prescribed mode? Prescribed mode means account pay check, account pay bank draft, electronic clearing system, and other prescribed modes. Other prescribed modes are there, no? This I have given in section number 40A3, where you can see all these modes of payments, that is credit card, debit card, NEFT, RTGS, IMPS, net banking, UPI, and Bhim Aadhaar Pay. All these are prescribed modes. This same section, no, prescribed mode 10,000 to a person in a day, it is repeated in so many sections. So one time you learn, that is enough, and in all these sections you can apply that automatically. So what are the prescribed payments? Account pay check, account pay bank draft, electronic clearing system, credit card, debit card, net banking, IMPS, RTGS, UPI, Bhim Aadhaar Pay. So all these are the prescribed modes of payments. Now coming back to the discussion. So whenever any payment is made more than 10,000 to a single person in a day, it should be through prescribed modes only. It should not be through other than prescribed modes. If it is other than prescribed mode, then you should not include it in the cost. Let me give you an example and let us see whether you are able to understand or not. Let's say you have purchased a furniture for 1 lakh rupees. For 1 lakh rupees, you have purchased furniture. For that, you have made different payments on different days to that person, to the furniture vendor. So let us see how much should be taken as the cost in case of Income Tax Act. First payment was made on 1/4/2025 for 10,000 rupees. Payment was made through cash. Will this payment be included in the cost? Answer is yes, it can be included, because up to 10,000 rupees you can pay in any mode. It can be through prescribed also, other than prescribed also, not a problem. Since it is exact 10,000, it is allowed, so you can include it in the cost. Then on 2nd April, 25,000 was paid through UPI. Is UPI a prescribed mode of payment? Answer is yes. So 25,000 also you can include it in the cost. Then on 3rd of April, 15,000 was paid through cross check. Is crossed check a prescribed mode of payment? Answer is no. Crossed check is not a prescribed mode. Similarly, bearer check also not a prescribed mode. Only account pay check is a prescribed mode of payment. So crossed check not allowed, bearer check not allowed, account pay check only allowed. Fine. Last one. On 6th of April, 20,000 was paid through cash. Since it is more than 10,000 to a person in a day, it is not allowed to be included in the cost. So now if you see in this 1 lakh rupees, you have to remove all the payments that are not allowed, that is other than prescribed mode. So balance amount only will be taken as cost as per Income Tax Act. So assessee has paid how much? 1 lakh rupees. But what will be taken as cost for calculating depreciation? Only 54,000 rupees will be taken as cost. Are you clear? Now let us come back to the discussion. Okay, so this is the normal method to calculate the actual cost in normal cases. Now let us talk about special cases. In special cases, how to calculate the cost. Firstly, the asset ceased to be used for scientific research. We are going to study in this video only that if at all an asset is used for scientific research, entire cost is allowed as deduction. Hence, actual cost minus deduction under section 35 will be taken as cost to calculate depreciation. So generally entire cost is allowed. That is why always the answer is going to come as 0, nil. So it will be added to the block but the value of the asset will be taken as 0. Then inventory converted to capital asset. If inventory is converted to capital asset, then fair market value of the inventory as on the date of conversion will be taken as actual cost for calculating depreciation. Then asset acquired by gift or inheritance. So if you have gotten an asset as a gift, then what will be the cost? The cost will be actual cost to the previous owner minus depreciation allowable plus freight or installation, etc. So you take the cost of the previous owner, you reduce whatever is the depreciation that would have been allowed, and you also add the expenses which is incurred by the assessee like freight, installation, etc. Then coming to fourth, second-hand asset. If an assessee is purchasing the second-hand asset, generally the purchase price is only the cost. However, sometimes the assessing officer might be suspicious that the assessee has paid only some amount, major amount through white money and gotten some amount back as cash. So some black money is involved in the transaction. In such case, the assessing officer will determine the actual cost on the previous approval of joint commissioner. So for example, one asset price is 10 lakh rupees, but just so that I can claim high depreciation, I purchased that asset for 1 crore rupees, second hand asset, so that I can claim high depreciation. So that balance 90 lakhs is there, no, that secretly I gave as cash to the vendor. So in this case, the assessing officer might feel suspicious that the asset value is very low, but he has shown such a high value. So he will take the approval of joint commissioner and he will decide what is the value of the second hand asset. It is only applicable to second hand asset, not applicable to new asset. Now let us talk about reacquisition of asset. Reacquisition means what? My asset I have sold to someone and from them I have repurchased that asset. That is only reacquisition. In such case, you have to see actual cost when it was first acquired minus depreciation allowable or reacquisition cost, whichever is lower. So in this case, let's say I am having an asset, I sold the asset and purchased that asset once again. In such case, you have to see my WDV or my purchase cost, that is the reacquisition cost, whichever is lower will be taken as cost of asset. Now let's come to acquisition of asset previously owned by any person to whom such asset is given on lease, hire or otherwise. So for example, Mr. A purchased asset from Mr. B who was already using the asset in the business and gave the asset to Mr. B on rent, lease or hire, etc. So for example, I am using an asset in the business, I have sold my asset and from that person who has bought, from them I have taken that asset on rent. So what did I say? I have sold my asset and from the buyer I have taken my own asset on rent and now I am paying him the rent. In such case, for my buyer, what will be the cost? The cost will be WDV of the asset in the hands of Mr. B. So what will be my WDV will be my buyer's cost. Okay, now let's talk about building previously owned by assessee which is brought into business. For example, I am having a building. This building I was using for personal usage. Now after 2 years, I want to start using this building for my business. So first I was having building, I was using it for personal purpose. Now after 2 years, I want to convert this building into business purpose. So in that case, for the business, what will be the cost? The cost will be actual cost of the building minus depreciation allowable. So let's say I constructed this building for 1 crore rupees and after 2 years I am converting into business. So what will be my cost in the business? 1 crore rupees minus depreciation for 2 years I have to reduce. Whatever balance amount is coming, that only will be taken as cost of the building. But however, this rule is there, this is not applicable to the assets other than building. So for example, I am having a car. This car I had purchased for 10 lakh rupees and I was using for personal purpose. For 5 years I used for personal purpose. But after 5 years I converted into business. Now what will be taken as cost in the business? The cost in the business will be 10 lakhs only. Okay, I need not reduce any depreciation from car. I should only reduce the depreciation allowable from building. You get my point? If at all it is any asset other than building, then this provision is not applicable. Directly you can take the actual cost as the cost. So even after 5 years, I am bringing my car from personal use to business use. Still, before 5 years, whatever I paid as the purchase price will be taken as the cost in my business. But in case of building alone, what I will do? Actual cost minus depreciation allowable. Now let's talk about asset acquired by non-resident outside India and brought into India. So if a non-resident is purchasing the asset outside India, later on bringing it into India, then in that case also the same building point will be applicable to them. That is actual cost minus depreciation allowable will be taken as cost for finding out further depreciation. Okay, actual cost of the asset. Then asset on which deduction has been claimed under section 35 AD converted into non-specified business before the specified time. So this we will be learning in 35 AD kanna. Next point also we will be learning in 35 AD itself. After learning 35 AD, you come back and see these points, you will be able to understand. So now we have seen all the special cases of actual cost also. Now you are thorough how to find out the cost of the asset. On this cost only you can claim depreciation. So to claim depreciation, you should also know what are the depreciation rates. So let us now see what are the depreciation rates under WDV method. So first let us talk about class by class. There are 4 classes no kanna: building, furniture, plant and machinery and intangible asset. So there are 4 classes. So first class let us discuss, that is building. In building, if the building is used for residential purpose other than hotel or boarding house, then the depreciation rate is 5%. So building other than hotel, boarding house, depreciation is how much? 5%. But if it is other than residential purpose, it is 10%. So residential purpose 5%, other than residential purpose 10% is the depreciation. However, if it is a temporary erection like a wooden structure etc., then for temporary building 40% is the rate of depreciation. Also, if a building is used in water treatment project or water treatment system, then 40% depreciation. So building, what did I say? Residential purpose 5%, other than residential purpose 10%. Hotel and boarding house, even though it is residential, still it will be 10%. Temporary building 40%, water treatment project, water treatment system 40%. So these are the rates for the building. Now let us talk about furniture. For furniture, always the depreciation rate is 10%. Furniture 10%, furniture 10%, and furniture also includes electrical fittings like wiring, switch, socket, fans and other fittings. So electrical fittings is also included in furniture, for which the depreciation rate is 10%. Now let's talk about plant and machinery. For plant and machinery, generally the depreciation rate is how much? 15%. Generally it is 15%, but let us see for specific asset what is the different rate. Firstly, let us talk about motor car. Motor car can be given on hire or not on hire. If the motor car is not given on hire, in such case, the depreciation rate is 15%, 15%. However, if the motor car was acquired and used between 23 August 2019 to 31/3/2020, that is during this period, the government has brought a scheme that during this period, if any person is buying a motor car and started using it for the business, then they can claim 15% extra depreciation. So that is why if any motor car was purchased between 23 August 2019 to 31/3/2020, then 30% will be the depreciation. Then what if a motor car or motor vehicle is given on hire? In such case, normal rate is 30%, and if it is acquired between 23 August 2019 to 31/3/2020, then the rate will be 45%. So generally 15 or 30, however 15% extra if it is acquired between 23 August 2019 to 31/3/2020. So you have to see what is the purchase date in the examination. If at all the examiner wants to set up a tough paper, they can give something like this. So you have to be thorough with the rates. Now let's talk about ship and boat. For ship and boat, always the depreciation rate will be 20%. Ship and boat 20%. Ship and boat 20%. Then molds used in rubber and plastic goods factory. So for molds the rate is 30%, and similarly for plant and machinery which is used in semiconductor industry, for that also 30%. So for mold it is 30%, for semiconductor industry plant and machinery it is 30%. Then for computer the depreciation is 40%. So now we are discussing the 40% category karna. Computer, it is always 40, and here no, computer does not mean only the computer, it also includes the software, and it also includes the computer peripherals and accessories like printer, scanner, mouse, keyboard, UPS, CPU, all these are included in the meaning of computer. So computer, the depreciation rate is 40%. But sir, can mobile phone be called a computer? Answer is no. Mobile phone is not a computer karna. That is why for mobile phone, always you will be charging 15% rate only, 40% will not come. Then life-saving medical equipment 40%, pollution control equipment 40%, solid waste control equipment, solid waste recycling and resource recovery 40%, windmill 40%, generator on wind energy 40%, solar energy 40%. So solar panel also 40% depreciation, and moreover if you are buying an electric vehicle, for that also 40% depreciation, aeroplane 40%, aero engine 40%, glass or plastic container used as refill 40%, electrically operated vehicle. So if you are buying a car which is an electric car, for that you can claim 40% depreciation. Then water treatment project, water treatment system, even if it is a plant and machinery, then also 40%. So water treatment project, water treatment system, if it is a building, then also 40, if it is a plant and machinery, then also 40. And lastly for books also, the depreciation is 40%. So what did I say? For computer, including computer peripheral 40%, life-saving medical equipment 40%, pollution control equipment 40%, solid waste control equipment 40%, windmill 40, generator on wind energy 40, solar energy 40, then solar panels also 40, aeroplane, aero engine 40, electrically operated vehicles, so electric car 40%, water treatment project, water treatment system 40%, books also 40%. So for all these assets, the depreciation rate will be 40%. Now let's talk about the last class, that is fourth class, intangible asset. So intangible asset, that is patent, trademark, copyright, etc. For them, the depreciation rate is always 25. 25% is the rate of depreciation for intangible assets. Now let us talk about block. You should know that for blocks you have to calculate depreciation together. So if there are two or more assets which belong to same class plus same rate, then you have to include the asset in the block, correct? Block. Now let me tell you an example. You see whether both the asset will be coming in the same block or different block. Let us see. First let us talk about commercial building karna. Commercial building, and there is a residential building. Residential building. Will both the buildings be considered as same block or different block? Answer is it will be considered different block, because for commercial building the rate of depreciation is 10%, for residential building it is 5%. So you have to consider them separately. Okay, you can't club both of them together because rate is different. Now let us talk about commercial building plus furniture. So for furniture also 10% is the rate. For commercial building also 10% is the rate. Can you combine both of them to call them a single block? Answer is no. You can't combine them into single block, because commercial building is coming under the building class, but furniture is coming under furniture class. Both the class are different. So even though the rate is same, still you cannot combine them in a single block. Now let us give you another example. Let's say there is a computer and let's say there is a book. Both computer and book, can I club in the single block? Answer is yes, you can call it a single block, because computer is also plant and machinery at 40% and book is also plant and machinery at 40%. So both belong to the same class, that is plant and machinery, and also having the same rate, that is 40%. That is why you can club book and computer. Both of them together will be coming under single block. Fine, you understood now how to club all the assets into single block. Now let us come back to the depreciation discussion. So block is equal to same class plus same rate. Same class plus same rate. So depreciation rate we have studied, actual cost meaning also we have studied. Now let me tell you about the 180 days concept. 180 days concept. Karna, if an asset is put to use for less than 180 days in the year of purchase, then for that asset you can claim only half depreciation. What did I say? In the year of purchase, if the asset was put to use for less than 180 days, you can claim only half depreciation. But if it was put to use for 180 days or more, you can claim full depreciation. Sir, what if the asset was not at all put to use? The assessee simply bought it and did not use the asset. In such case, no depreciation is allowed, because depreciation is only allowed if the asset is used for business. You get my point? So if it is not used, no depreciation. If it is put to use for less than 180 days in the year of purchase, then less than 180 days in the year of purchase, then half depreciation. Otherwise it is full depreciation. So 180 days or more, it is full depreciation. And also if it is purchased in some previous year itself, preceding previous year itself it was purchased, but in the previous year it was used for less than 180 days, then also full depreciation. So half depreciation only comes when there is less than 180 days use and purchase during the same year. So then half depreciation. Okay, wow. Half depreciation. Now let me tell you about additional depreciation. Additional depreciation. Additional depreciation is allowed only if the conditions are satisfied, and the additional depreciation is always 20%. Always 20%. In additional depreciation also, if the asset was put to use for less than 180 days in the year of purchase, 10% is allowed in first year, balance 10% is allowed in second year. You get my point? So 10% in year 1 and 10% in year 2 will be allowed as deduction. Then what are the conditions to claim the additional depreciation, sir? To claim additional depreciation, the assessee should be engaged in business of any of the following, that is manufacture, production, printing and stationery, generation of power, transmission of power, or distribution of power. So what did I say? The assessee should be engaged in manufacture or production or printing and publishing, or generation or transmission or distribution of power. So only in these cases the assessee can claim additional depreciation. Other assessees cannot claim additional depreciation. So sir, one person is only doing trading business, sir, can they claim additional depreciation? Answer is no. Only in case of manufacture or production, or printing and publishing, or power generation, power distribution and power transmission business, you can claim additional depreciation. Then additional depreciation can only be claimed on new plant and machinery. It cannot be claimed on any asset other than plant and machinery. It cannot be claimed on old plant and machinery. And depreciation has to be calculated only as per WDV method. So SLM method cannot claim additional depreciation. And if the assessee opts out of default tax regime, they cannot claim, then only they can claim additional depreciation. So in default tax regime, it is not allowed. Only in the opt-out regime, it is allowed as deduction. So what did I say? Who can claim additional depreciation? Any assessee who is engaged in manufacture or production or printing and publishing, or generation or distribution or transmission of power. Then only they can claim additional depreciation. They should opt for the old tax regime. So they should opt out of the default tax regime. Then only they can claim additional depreciation. Additional depreciation can only be claimed on new plant and machinery. So the plant and machinery should be there and it should be new. Only then it can be claimed. Rate of additional depreciation is 20% and it is allowed only one time. It is not allowed every year, Kanna. It is allowed only in the first year and only one time. But in the first year itself, if it is put to use for less than 180 days in the year of purchase, then 10% is allowed in first year, balance 10% is allowed in the second year. Fine, you get my point? Then exceptions. Now in the 6 categories of asset, you cannot claim additional depreciation. What are they? Number 1, used plant and machinery. So in case of used plant and machinery, you cannot claim additional depreciation. It does not matter whether the plant and machinery is imported plant and machinery or not, whether 20% is only used or not, that and all you should not see. All that condition is there only in special economic zone and 35 AD deduction, but here there is no such condition. It is very, very strict. If it is used means you cannot claim additional depreciation. Then for ship or aircraft you cannot claim. For road transport vehicle also you cannot claim. But you know what? There is a truck called forklift truck. This forklift truck is not considered as road transport vehicle. So for forklift truck, you can claim additional depreciation. Okay. Then for office appliances, you cannot claim. Plant and machinery installed in office premises or residential accommodation or guest house, you cannot claim. Plant and machinery for which entire cost is already allowed as deduction, for that also you cannot claim. So when I cannot claim, number 1, for used plant and machinery, not allowed. Then for ship, aircraft, road transport vehicle, not allowed. Then for office appliances, not allowed. For plant and machinery installed in office or residential accommodation, not allowed. And finally, if already deduction has been allowed in some other section, then you cannot claim additional depreciation. So all these are the exceptions for additional depreciation. Now let me show you how to do the calculation, sir. Be very attentive now. Listen carefully. Okay. So how to calculate depreciation? Firstly, you have to do step number 1. Take the opening WDV. So what is the opening WDV? Take the previous year closing WDV, and from that you reduce the preceding previous year closing WDV. From that you reduce the depreciation of preceding previous year. Okay, so you will get the opening WDV of the previous year. However, in the question, if you are not getting preceding previous year depreciation, then directly take the preceding previous year closing WDV as the opening WDV of the previous year. Fine. Now, step number 2, add all the purchases or additions during the year. Add all the purchases, add all the additions during the year. Step number 3, reduce all the sales during the year, or if the asset is destroyed, you will get insurance claim, no, that you have to reduce. Fine. So reduce all the money receivable on the asset sold or destroyed during the year. Then step number 4, the total value, you will get this total value for calculation. So first step, what you should do, take the opening WDV. Then from this, what you have to do, you have to add all the purchases. Okay. Then you have to reduce all the sales. But in income tax language, this purchases is nothing but additions and sales is nothing but money receivable. This you have to reduce. So you will get the total. Now in this total only you have to calculate depreciation. But here you have to remember one point. Kanna, if the total is coming in negative, it means that it is short-term capital gain. So this negative amount, directly you have to add it as the income in capital gain chapter as short-term capital gain, and no need to calculate any depreciation if it is negative. However, if it is positive, then you have to see whether any asset is remaining. If asset is remaining, then only you have to calculate depreciation. If there is no asset remaining, means all the assets have been sold, still I am getting positive value, sir. In such case, it will be called a short-term capital loss. What did I say? Take the opening WDV plus purchases minus sales. You will get what is the total. If the total is negative, it means it is a short-term capital gain. If the total is positive, see whether there is any asset left in the block or not. If any asset is left in the block, then calculate depreciation. If no asset is left in the block, it means the block itself is not existing. So positive amount will be called as short-term capital loss. You get my point? Now, if at all you are having positive answer and if any asset is remaining, then what you have to do? Take this total and divide the total into 3 categories. First category is not put to use category. Second category is put to use for less than 180 days in the year of purchase category. And third category is the balancing figure, that is put to use for more than 180 days, that is 180 days or more. Always you have to fill first category first, that is not put to use category first, then less than 180 days second, whatever balance amount is there, no, that you bring it to the third category. So third category, don't calculate, don't sit in the exam hall and calculate, because depreciation is an illogical section. If you calculate, no, you will get confused. So always use this shortcut method. What is the shortcut method? Whatever total you are getting, this total you divide into 3 categories. First, you see whatever assets are not put to use, you put it here in the first category. Then you see whatever the asset are put to use for less than 180 days, you put in second category, and whatever balance amount is there in the total, that you have to put in the third category. So for first category there is no depreciation, for second category there is half depreciation, and third category you have to calculate full depreciation. Okay, then whatever is the total, full depreciation plus half depreciation will give you the total depreciation. After that, you have to further reduce additional depreciation in case of old tax regime if the conditions are satisfied. So conditions I told you, no, assessee should be engaged in manufacture, production, printing, publishing, generation, transmission, distribution of power. The asset should be a new plant and machinery. The plant and machinery should not be a old plant and machinery. It should not be road transport vehicle. It should not be ship. It should not be aircraft. It should not be any office appliance, or it should not be installed in office or residential accommodation or guest house, or deduction should not have been claimed in any other sections. If all these conditions are satisfied, 20% additional depreciation can be claimed. If the asset is put to use for less than 180 days, then 20 days in year, 10% in year 1, 10% in year 2, you can claim as additional depreciation. If at all it is given in the question that last year, that is in preceding previous year, the assessee had purchased one asset on which additional depreciation was claimed, 10% was claimed in that year. So this year also you have to claim balance 10%. That you don't forget, Elena, you will make silly mistake. So you have to find out additional depreciation, then from the WDV reduce the depreciation also, additional depreciation also. You will find out what is the closing WDV of the previous year. So this is the method to calculate depreciation. So depreciation, such a long discussion. With this, depreciation is over, and now let us talk about last point. Okay, depreciation not yet over. One small point is pending, which is unabsorbed depreciation. Sir, what is this unabsorbed depreciation? Sir, unabsorbed depreciation means the PGBP income is not even sufficient to absorb the depreciation. Let me give you an example. Let's say there is a profit and loss account where the sale is coming as 2 lakh rupees, depreciation is 5 lakh rupees, and all the other expenses are 20 lakh rupees. So total expense is 25. Because total expense is 25, but the income is only 2 lakh rupees, that is why 23 lakh rupees is the loss of PGBP. Now this loss you can divide into two parts. That is, 3 lakhs is the unabsorbed depreciation. Because this 2 lakhs income was able to absorb only 2 lakhs of depreciation, balance 3 lakh is unabsorbed depreciation, and all the remaining expense will be considered as normal PGBP loss. Normal PGBP loss. It is important to differentiate the loss into unabsorbed depreciation and normal PGBP loss. You know why? Because unabsorbed depreciation will get some benefits. What are the benefits? The benefit is that unabsorbed depreciation can be carried forward for unlimited number of years. So next year you can carry forward, and if you are not able to adjust in next year also, then next year you can carry forward, and you can keep on carrying forward the unabsorbed depreciation. Moreover, after doing carry forward, generally you can adjust only against the same head of income, but in case of unabsorbed depreciation, you can adjust against the other heads of income also, other than salary. This I have also discussed when I am taking the set off and carry forward chapter. So that time once again it will be revised for you. Moreover, now listen here. Additional depreciation should not contain unabsorbed depreciation should not contain additional depreciation when the assessee is going into new tax regime. Karna, what did I say? Additional depreciation is only allowed in the old tax regime. It is not allowed in the default tax regime. That is why if the assessee is taking the default tax regime, and while taking default tax regime, if at all there is any unabsorbed depreciation, and inside that unabsorbed depreciation if there is any additional depreciation, then that additional depreciation you cannot carry forward. So what you will do, whatever is the additional depreciation inside the unabsorbed depreciation, you have to add back to the WDV of the asset. You have to add back to the WDV whenever the assessee is shifting to the default tax regime. Fine. So this is the provision. Now let us talk about section number 35, which speaks about expenditure on scientific research. There are two types of expenditure on scientific research, Karna. First is in-house research, which means what? Doing the research within the organization. The assessee is doing research himself. That is only in-house research. And second one is contribution. It means what? The assessee is contributing to other organization for the purpose of scientific research. Firstly, let us talk about contribution, Karna, because contribution is not allowed in the default tax regime. It is only allowed as deduction in the optional tax regime. Fine. What is contribution? Entire contribution made to the following shall be fully allowed to the assessee if assessee opts out of 115 BAC. So these four cases are there. No, 100% of the contribution will be allowed as deduction under section 35. What are the contribution? Number one, contribution to notified and approved research association, university, college or any other institution for scientific research, and also for social and statistical research, social science or statistical research. Then national laboratory, university or Indian Institute of Technology for the purpose of scientific research. And lastly, approved Indian company which is registered in India and which is having a main object in the memorandum of association of scientific research for the purpose of scientific research. So to whom can assessee contribute? Number 1, notified approved research association, university, college or other institution for scientific research. Number 2, notified approved research association, university, college, other institution for social science or statistical research. Number 3, national laboratory, university or IIT for scientific research. And number 4, approved Indian company for scientific research. So in this all these 4 cases, entire amount of contribution is allowed in the old tax regime. It is not allowed under section 115 BAC, that is default tax regime. Now let us talk about in-house research. In-house research is allowed both in the old regime as well, it is allowed in the default regime as well. What is in-house research? In-house research means assessee is doing scientific research within his own organization. So first let us talk about revenue expenditure. Revenue expenditure is fully allowed as deduction under section 35. Then capital expenditure also fully allowed as deduction other than land. So except land, whatever capital expenditure is done, entire amount is allowed as deduction. So it is a very huge section. Generally capital expenditure, you will put it in the asset, block of asset, and you will claim as depreciation, correct? But however, in case of scientific research, entire amount of capital expenditure is also allowed as deduction. Now let us talk about prior period. Sir, what is prior period? In case of section number 35, prior period means within 3 years before the date of commencement of business, before the year of commencement of business. Okay, well, if in the prior period there is any revenue expenditure, then only 2 types of revenue expenditure is allowed karna. That is salary, and second one is raw material for scientific research. That too in salary, perquisites is not allowed. Only other than perquisite, whatever salary is paid to the employee for the purpose of scientific research will be allowed as deduction, and raw material for scientific research also will be allowed as deduction. Then coming to capital expenditure, even prior period capital expenditure will be fully allowed as deduction except land. So land is not allowed as deduction under section 35. So what did I say? Once again, listen, very very important. In-house research means doing research within the organization. If it is a revenue expenditure, fully allowed. Capital expenditure also other than land, fully allowed. Now let's talk about prior period expenditure. Prior period means that 3 years before the year of commencement of business. So within that 3 years, whatever revenue expenditure is done towards the salary and raw material is fully allowed as deduction, and capital expenditure also other than land fully allowed as deduction. You get my point? Now let's talk about sale of scientific research asset. So if you have purchased a capital asset on which you have claimed scientific research deduction, that is 100% deduction, and later on you are selling that asset, then what will happen? Firstly, let us see what happens if the asset is converted into business. So if the scientific asset is converted into business as a business asset, then add it to the block of asset and take the value as 0. This I already discussed while telling about the actual cost concept. Then what if without using in the business, if it is sold? If it is sold without using in the business, then PGBP income is equal to selling price or deduction claimed, whichever is lower, and capital gain income is equal to selling price minus cost of acquisition. So the entire cost only you are going to claim as deduction. No, cost of the asset into 100% will be claimed as deduction under section 35. So let's say if the asset is sold, then up to the cost whatever amount is received will be income under PGBP head of income. Okay, and above the cost if you are receiving, so for example the asset was purchased for 1 crore but it is sold for 1.2 crores. In that case 1 crore will be PGBP income, balance 20 lakhs is there, no, the balance 20 lakhs will be capital gain income. So capital gain income is equal to selling price minus cost price. So up to cost price PGBP income, above cost price it is capital gain income. There is no concept of capital loss karna. Okay, because the value itself is 0. So however, whatever amount you are selling will be treated as profit only. Now let us see other notes. Deduction cannot be denied merely because approval was withdrawn after contribution. When the assessee is making the contribution, no, in case of the second category, that time the assessee should make sure that the association is notified and approved. But after doing the contribution, later on if the approval is withdrawn, then is it the assessee's mistake? Answer is no. While making the contribution, he made sure that it is notified and approved. That is why still it will be allowed as deduction. If land and building value is not given separately in the question, then you have to find the value of building and allow it as deduction. So take the value of land, you separate it from land and building, balance amount will be the value of building. Value of building can be claimed as deduction. Then unabsorbed scientific research is treated the same way like unabsorbed depreciation. So unabsorbed depreciation, I told you, it can be carried forward for unlimited number of years, and in next year also it can be set set off against any head of income other than salary. So that same rules will apply to unabsorbed scientific research also. Now let's come to section 35AD, specified business. So 35AD is a special section where entire capital expenditure including prior period capital expenditure 100% will be allowed as deduction if the assessee is doing any of the specified business which is mentioned in the section. So let me tell you more about it. This 35AD specified business section is not allowed under section 115 BAC. So you cannot claim this deduction under the default tax regime. You can claim this deduction only in the old tax regime. Moreover, this deduction is an optional deduction. In the old regime also, if the assessee wants, he can claim the deduction. If the assessee does not want this deduction, he can ignore this deduction and go by the normal provisions of the PGBP head of income. You get my point? So what is the deduction, sir? The deduction is that if any of these specified business which I am going to tell you, if the assessee is going to start this business, then in the year of commencement of business, that is the first year of business, in that 100% capital expenditure including prior period expenditure can be claimed as deduction. So 100% capital expenditure in the year of commencement and even prior period expense. And in section 35, what did I tell you? Prior period means 3 years before the commencement of business. But here there is no such rule. Entire prior period expense, even if it is 5 years before the commencement or 6 years before the commencement, still it will be allowed as deduction. So even prior period is allowed. But you know what? 3 types of capital expenditure not allowed as deduction. In section 35, what did we study? Only one capital expenditure, that is land, will not be allowed as deduction for scientific research. But for specified business, there are 3 types of capital expenditure not allowed as deduction, and that is goodwill, financial instrument and land. You can remember like this: GIL, GIL. Okay, goodwill, financial instrument and land. So goodwill means goodwill of business, financial instrument includes shares, debentures, bonds, derivatives, etc. and land also not allowed as deduction under section 35 AD. So other than goodwill, financial instrument and land, all other capital expenditure in the year of commencement of business including prior period capital expenditure is fully allowed as deduction. Now what are the specified businesses? Let us see. So there are 14 specified business Kanna. I am going to tell all of them one by one. Sir, you should you remember all this? Answer is not required. I am going to tell them no. You at least listen to it 2 times or 3 times or 4 times, or read this at least 4 or 5 times, so that if you are seeing the business name in your question paper, you should be able to identify that it is a specified business. You get my point? So what are the businesses? First one, cold chain facility for agriculture produce, forest produce, meat, poultry, marine, dairy, horticulture, floriculture and apiculture. So agriculture produce, etc. For that, if there is a cold chain facility, that is a specified business. Then warehousing facility for agriculture produce, it is a specified business. Then warehousing facility for sugar, it is a specified business. But if at all there is warehousing facility for edible oil, is that a specified business? Answer is no. Edible oil is not a specified business Karna. Warehousing for agriculture produce is a specified business. Warehousing for sugar is a specified business. Then laying and operating natural gas, crude or petroleum oil pipeline network is a specified business. Then slurry pipeline to transport iron ore from one place to another place is a specified business. Then hotel of 2-star or above category in India. So in India, if you are having a 2-star hotel, 3-star hotel, 4-star hotel, 5-star hotel, everything is a specified business. Then hospital with at least 100 beds in India. In India, you are constructing one hospital, there should be at least 100 beds for the patient. So that is a specified business. Then housing project for slum redevelopment or slum rehabilitation. So housing project for slum redevelopment, and then second one is housing project for affordable housing scheme. This is also specified business. Then inland container depot, container freight station. This is nothing but warehouse for the purpose of storing the export import products. This you will be learning in your CA final level in customs. Okay, inland container depot and container freight station. Then semiconductor wafer fabrication manufacturing unit, it is also specified business. And then 12th one is infrastructure facility. So what is this infrastructure facility? It means constructing, developing, maintaining road, highway, bridge, rail system, port, airport, inland waterway, water supply project, water treatment system, irrigation project, sanitation, sewerage system, or solid waste management system. So all these are infrastructure facility. Then 13th one is production of fertilizer in India. That is also specified business. And last one, beekeeping and production of honey and beeswax. So all these are specified business. Once more I am going to tell you what are all the 14 specified business. First, cold chain facility for agriculture and other products. Then warehousing facility for agricultural produce, warehousing facility for sugar, laying and operating natural gas, crude, petroleum, oil pipeline network, slurry pipeline to transport iron ore, hotel of 2-star or above category in India, hospital with at least 100 beds in India, housing project for slum redevelopment or rehabilitation, housing project for affordable housing scheme, inland container depot, container freight station, then semiconductor wafer fabrication manufacturing unit, then new infrastructure facility, then production of fertilizer in India, and last one, beekeeping and production of honey and beeswax. So all these are specified businesses. For these specified businesses, I told you 100% capital expenditure is allowed as deduction in the year of commencement, including prior period expense and except goodwill, financial instrument and land. For that, there are some other conditions as well. What are the conditions? First one, payment should be made to a person in a day greater than 10,000 rupees, should be through any mode, which should be through prescribed mode only, should not be through other than prescribed mode. This we have already studied when we were discussing about the actual cost. Same type of provision is repeated once again in section 35 AD. So whatever payment should be made, it should be made through prescribed mode only. That is account pay check, account pay bank draft, electronic clearing system, debit card, credit card, NEFT, IMPS, RTGS, UPI, Bhim, Aadhaar Pay. So all those prescribed mode only payment should be made. If a payment is made greater than 10,000 to a person in a day, fine. Then business should not be set up by splitting up or reconstruction of an existing business. I told you in the first year of the business only this deduction is allowed. So this first year of business, some people will, what they will do, existing business itself, they will rebrand it as a new business. Is it allowed as deduction? Answer is no. It should be a genuinely new business. Then third one, investment, if it is in plant and machinery, then the plant and machinery should not be a used plant and machinery. Plant and machinery should be new plant and machinery only. However, there are two exceptions for used plant and machinery. That is, the value of used plant and machinery should not be more than 20% of the total value of plant and machinery. So if 100 crores is spent in plant and machinery, up to 20 crores can be used also. It is not a problem. Even this 20% will be considered as new. And second one, imported plant and machinery will not be considered as old if at all it was used, but it was not used in India before installation and no depreciation has been claimed on it. So from outside India, if you are importing second hand plant and machinery, however you have not used it in India, and in India you have not claimed depreciation also, in such case even second hand machinery that you are importing will be considered as new plant and machinery. But be careful, Kana, these two exceptions are there. This is only there in section 35 AD that we are discussing now, and in section 10 AA, that is special economic zone. But when we discussed about additional depreciation, there is no such exception. For additional depreciation, 100% should be new only. However, for 35 AD, there are two exceptions. What is the exception? The 20% old plant and machinery is also okay. Moreover, if imported plant and machinery is there, if it is second hand, but if it is not used in India and depreciation has not been claimed, then such imported second hand plant and machinery also will be considered as new plant and machinery. Fine. Then if deduction is allowed under section 35 AD, then other deduction like section 10 AA or chapter 6A will not be allowed for the same expenditure. Okay, so once you claim in 35 AD, you cannot claim in other places. Then the asset on which the deduction is claimed should be used for the specified business at least for 8 years. So whatever asset you are claiming this expenditure deduction, 100% capital expenditure, this you should use it for the specified business only for at least 8 years. If you are not using for the same specified business, no problem, you can use it for other specified business also, but you should only use it for specified business. Audit of books of accounts by a chartered accountant is compulsory in case of 35 AD. Now let us talk about set off and carry forward of losses. For section 35 AD, the set off and carry forward provisions are little bit different. Generally, PGBP loss can only be carried forward for 8 years. Okay. However, in case of 35AD business, if at all there is a loss due to this deduction, then you can carry forward that loss for indefinite number of years. There is no limit at all. Any number of years you can keep on carry forward. And then second one, that you can, in normal PGBP laws, you can set off against any head of income other than salary. You can set off against PGBP also, other heads of income also. However, when it comes to section 35AD business laws, you can only set off against the profit of a specified business under section 35AD. So loss of specified business can only be set off against the profit of another specified business. Set off can be done irrespective of whether the latter is eligible for deduction under section 35AD or not. Kanna, I am having two business. One business is a hotel business, another business is a hospital business. Let us assume both of them are specified business. Let's say in hotel business I am having 1 crore loss. Now in hospital business, I am having 2 crores profit. However, this hospital business, no, I have not claimed any section 35AD specified deduction. Still, can I adjust this loss against the profit of hospital business? Answer is yes. Still you can adjust. So it does not matter whether the profit of specified business is there. No, in that you had claimed this deduction or not claimed the deduction. That does not matter. The only rule is that if at all you are having a loss from a specified business, you can set off against the profit of another specified business. That is only the rule. Okay, then next one, the loss which could not be set off can be carried forward indefinitely. This I already told you. Now let us see what happens if you are converting the specified business asset to non-specified business, or if you are selling the specified business asset, then what happens? Firstly, what happens if the asset is sold? If the specified business asset is sold, then the entire income the entire amount that is received will be treated as income under PGBP. Entire amount. Here in section 35, no, we had discussed up to cost it will be considered as PGBP income. Above the cost it will be considered as capital gain income. But here there is no such rule, Kanna. In section 35AD, whatever amount you are receiving, even if it is above the cost, entire amount will be treated as income under PGBP. Okay, so whatever amount is received on sale will be treated as income under PGBP. Then if asset is transferred to another specified business, so if it is one specified business, you are transferring the asset to another specified business. Sir, I was having a hotel, sir. In that I was having a building where I had claimed a specified business deduction, the 35AD deduction. Now this building I am transferring to hospital business. Is it allowed? Answer is yes. From one specified business you can transfer to another specified business. There is no restriction, Karna. Now let us talk about what happens when you are transferring from one specified business to a non-specified business. Here I told you, no, up to 8 years you have to compulsorily use in specified business only. So within 8 years if you are transferring to non-specified business, then the Income Tax Act will punish you. What is the punishment? Whatever deduction that you have claimed under section 35AD, that now will become deemed as income. It will become deemed income. So whatever deduction was claimed under 35AD will become deemed income. However, if you would have not claimed under section 35AD, then you would have claimed depreciation. Okay, let's say I was having a section 35AD specified business asset. There is one building. Okay, in the hotel asset, in the hotel business, there is a building. On this building, I had claimed section 35AD deduction. Okay, after 5 years, I transferred the building to my clothing business. Clothing business. So clothing business is a non-specified business. Correct. Now when I transfer within 8 years from specified business to non-specified business, then what will happen? Then I have to reverse my deduction. So let's say this building cost me 100 crores and I had claimed 100 crores as deduction. So now what I have to do? I have to reverse this 100 crores. So now this entire 100 crores will be treated as deemed income, Kanna, under PGBP. But you know what? If at all I had not claimed this 100 crores as deduction, then I would have claimed a depreciation, no? Then I would have claimed depreciation, no? That is why entire amount you need not reverse. You have to reverse only 100 crores minus the depreciation that would have been allowed. That would have been allowed. So here what you have to do, deduction claimed under section 35AD minus the depreciation that would have been allowed had it been used for non-specified business. That only will be treated as income under PGBP. Fine. Then above amount shall also become the actual cost of the asset and added to the block of asset. So this same amount which is treated as income, no, it will be treated as cost of the asset, and that you have to add it to the block of asset. However, if you transfer the asset to a non-specified business after 8 years, there is no problem. So after 8 years, no income under PGBP, actual cost of the asset to be added to the respective block shall be taken as 0. So after 8 years, you can directly transfer to non-specified business, and when you are adding it to the block of asset, the cost will be taken as 0. So that is the only provision. So this is section 35 AD, very very important. After this revision lecture, definitely you are going to solve the questions karna. There are 2 or 3 questions only in the study material. All the 2 or 3 questions you solve it, you will be thorough with the deduction. Very important, because a specific question can be asked in the examination. If it is asked, it will come at least for 6 to 8 marks. Okay, now let us talk about section 35D, that is amortization of preliminary expenditure. So what is preliminary expenditure? Before the incorporation, whatever expenditure is done, that is only called preliminary expenditure. Preliminary expenditure is allowed as deduction under section 35D, but it is allowed only to resident and Indian company. So resident assessee and Indian company only can claim deduction. Non-resident foreign company cannot claim deduction. Moreover, this deduction is not allowed in one shot. This deduction is allowed in 5 equal annual installment karna. 5 equal annual installment. So whatever amount that you are going to calculate, that you have to divide by 5, and every year you have to claim for 5 years. That is section 35D. In section 35D, now let us see what can be claimed as deduction. Firstly, let us talk about resident assessee. Resident assessee can claim actual expense or 5% of cost of project, whichever is lower, as deduction. So what is this actual expense? Actual expense means feasibility report, project report, market survey, engineering service, legal charges. So there are 5 types of preliminary expense. What are they? Feasibility report, project report, market survey, engineering service, legal charges. So 5 types of preliminary expenditure. If at all it is an Indian company, so 3 more types of expenditure are allowed. That is drafting of article of association and memorandum of association, then printing of article of association and memorandum of association, and last one is underwriting commission or brokerage or any other expense relating to the public issue of shares and debentures. So there are 8 type of expense for Indian company, but for other than Indian company there are 5 types of expense. So once again I am telling what is actual expense: feasibility report, project report, market survey, engineering service, and legal charges. And for Indian company it also includes drafting of article of association and memorandum of association, printing of AOA and MOA, and lastly underwriting commission, brokerage, or any other expense relating to public issue of shares and debentures. So this is actual expense. This actual expense, entire amount you can claim as deduction. However, it should be restricted to 5% of cost of project. So maximum 5% of cost of project only you can claim as deduction. Now what is this cost of project, sir? Cost of project means amount invested in the fixed asset of a new business or extension or setting up of a new unit as per the books of accounts as on the last day of the year of commencement of or extension. So during the year of commencement, you come to the last day. In the last day of the year of commencement, you see the books of accounts. Whatever is the investment of fixed asset, that only will be called as cost of project. So this cost of project multiplied by 5%. Maximum 5% of cost of project only allowed as deduction. However, you know what? For Indian company, they have the option to choose their higher limit as either 5% of cost of project or 5% of capital employed. So they can choose 5% of cost of project also, they can choose 5% of capital employed also. What they will choose? Obviously they will choose the higher amount so that they can get higher amount of deduction. Okay, Now what is this capital employed? So capital employed means issued share capital plus long-term borrowings plus debenture. What did I say? Issued share capital plus long-term borrowings plus debenture as on the last day of the year of commencement. However, don't include reserves and surplus and security premium. Don't include reserves and surplus and security premium. You should only include what is the issued share capital. That's it. Other than that, long-term borrowings and debentures. This is capital employed. So capital employed also you have to multiply by 5%. So what did I say? In case of Indian company, first step, you take 5% of cost of project or 5% of capital employed, whichever is higher. Then the higher value or actual expense, whichever is lower, will be allowed as deduction under section 35D. And will the entire amount be allowed? Answer is no. It is allowed in 5 equal annual installments. Okay, Entire amount you should not claim. Now what are the other points we have to keep in mind? So this deduction is not allowed to non-resident and foreign company. Then deduction is allowed for expenses incurred before the commencement of business or extension. So preliminary expense itself means prior period expense. Then assessee has to furnish the details of the expenditure to the income tax authority within 1 month prior to the due date of filing return of income. So it is compulsory to give the details to the income tax authority. So this is only section 35D kana, which is preliminary expenditure. So 2 more points are there. If deduction is claimed by a person other than company or cooperative society, then audit is compulsory. Audit is compulsory. Then if deduction is allowed under section 35D, no other deduction shall be allowed for the same expense. So same expense, that is prior period expense, you can't claim in 35D as well as 35. You can claim only in one place. Okay. Now let's talk about section 35 DDA, expenditure on voluntary retirement scheme. In salary also we studied voluntary retirement scheme. No, it was from employee point of view. Now we are seeing voluntary retirement scheme from employer point of view. So when employer is giving a voluntary retirement scheme, he has to spend so much money to give the lump sum amount to the employees so that they can leave the organization. Is voluntary retirement scheme expense allowed as deduction? Answer is yes. Entire amount can be claimed as deduction, but it can be claimed in 5 equal annual installment karna. 5 equal annual installment. So preliminary expense also 5 equal annual installment, VRS also 5 equal annual installment. Sir, what if within this 5 years there is an amalgamation or demerger? Then what will happen? Then the balance deduction is there, no? It can be claimed by the new company. The amalgamated company or the resulting company can claim the balance expenditure. Now comes section 36, but before discussing section 36, it is important that we discuss section 43B first. Section 43B, deduction allowed on actual payment basis. Okay, deduction allowed on actual payment basis is given under section 43B. So what are these deductions? Now I am going to tell you certain deductions, point number 1 to point number 8. These deductions are only allowed if the actual payment of the amount has been made on or before the due date of filing return of income. So within the previous year, for you, what is the previous year? The previous year is 25-26. Okay, let's assume the due date is 31/7/2026. So whatever expenditure has been claimed in 25-26, that actually has to be paid within 31st July 2026. If it is paid within 31st July, entire amount will be allowed in previous year 25-26 itself. But sir, what if it is paid afterwards? If it is paid on 1st August, what to do? If it is paid on 1st August, then it will be allowed in the year in which the payment is made karna. So next year it will be allowed as deduction. Okay, so what are the expenses? Let us see. First and foremost, any tax, duty, cess or any other fee payable. So for example, if you are importing the goods and you are paying the custom duty, the custom duty you can claim as deduction only if you are making the actual payment of custom duty within the due date of filing return of income. Then interest. Next 2, 3, 4, all 3 points are related to interest. Interest to scheduled bank, interest to cooperative society, interest to public financial institution, state financial corporation or state industrial investment corporation, and then lastly notified class of NBFC, that is non-banking finance company. So these 3 cases, if you are making the interest payment, generally in mercantile system you can take the deduction on accrual basis, correct? However, even if you are taking the deduction on accrual basis, the interest should be actually paid on or before the due date of filing return of income. Okay, and here now you have to keep one thing in mind. If this interest is converted into a loan or borrowing or advance or debenture or any other instrument by which liability is deferred to a future date, it shall not be considered as actual payment. The deduction will be considered as actual payment only in the previous year in which the converted interest is actually paid. So what did I say? Whenever there is an interest, sometimes the assessee will not be able to pay the interest on time. So as a settlement, what the bank will do, the interest itself is there, it will convert it into a loan and it will tell that now in the few more installments you can repay this loan. So when interest is converted to loan, is it called payment of interest? Answer is no. It is only converted into loan. When you are actually paying this loan only, it will be considered that you have repaid the interest and then only it will be allowed as deduction. So interest to scheduled bank, cooperative society, cooperative bank, public financial institution, state financial corporation, state industrial investment corporation, and notified class of non-banking finance company will only be allowed as deduction if it is actually paid on or before the due date of filing return of income. Then now next 3 points are related to employer-employee relationship karna. So what is the first one? Bonus or commission. So if you are paying any bonus or commission to employee, then actually pay it to the employees within the due date of filing return of income. Then leave salary. Leave salary also has to be paid within the due date of filing return of income. And lastly, employer contribution to welfare funds. So if employer is making any contribution to any welfare funds like gratuity fund, provident fund, superannuation fund, pension fund, then it should be actually paid within the due date of filing return of income. And last one is payment to railway authority for using the railway asset. So payment to railway authority also should be made within the due date of filing return of income. So all these 8 cases, number 1 to number 8, is allowed as deduction only if the payment is made within due date of filing return of income. If payment is not made, it is not allowed. If it is late, let's say after the due date, if you have made the payment, then in that year you can claim the deduction. Okay, now let us talk about payment to MSME. That is micro or small enterprise as per MSMED Act. Here no kanna, for MSME it is a little bit different and you have to be very thorough because there is amendment also. It is important also, there is amendment also. So what is micro enterprise and small enterprise? Micro enterprise and small enterprise is defined in MSMED Act. So you have to see what is the investment in plant and machinery or equipment and also what is the turnover. If investment in plant and machinery or equipment is up to 2.5 crores and the turnover is up to 10 crores, so it means both conditions should be satisfied. If investment in plant and machinery is up to 2.5 crores and the turnover is up to 10 crores, it is called micro enterprise. If investment in plant and machinery is up to 25 crores and the turnover up to 100 crores, then it is called a small enterprise. Small enterprise. So this micro is there, no? You learn micro, multiply it by 10, it will become small. Okay, that is the limit of small. So up to 25 crores and up to 100 crores is the limit. Investment in plant and machinery up to 25 crores and turnover up to 100 crores will be considered as small enterprise. Now why are we learning micro and small? Because if any payment is being made to the micro enterprise or small enterprise, then such payment has to compulsorily be made within the due date as per MSMED Act. So for first 8 points, what did we see? That the payment should be made within the due date of filing return of income. But for micro and small enterprise, the payment has to be made within the due date as per MSMED Act. Sir, what is the due date as per MSMED Act? Let us see now. Let's say Mr. A has purchased the goods from Mr. B. Mr. B is the centric creditor and Mr. B is also a micro or small enterprise. In such case, the payment has to be made within the time limit as per MSMED Act. What is the time limit? For this you have to see whether there is any agreement or no agreement. If there is any agreement, then the time limit should be as per agreement or 45 days maximum. The payment should be within 45 days maximum or time limit as per agreement. Let's say agreement is for 30 days, then the payment has to be made within 30 days. If agreement is for 40 days, then within 45 days. But if agreement is for 50 days, then what you will do? Then you should not see 50, then you should consider 45 only. So if there is any agreement, then you have to make the payment within the agreement date. However, maximum it can be 45 days. However, if there is no agreement, then within 15 days you have to make the payment. So Mr. A has to make the payment if there is no agreement within 15 days. If there is agreement, then as per the agreement he has to make the payment maximum within 45 days. So it cannot be more than 45 days. Never. Okay. If the amount is not paid, then amount will not be allowed as deduction. So whatever amount is paid only will be allowed as deduction. If not paid, not allowed as deduction. And if it is paid late, then deduction only will be allowed in the year of payment. So if you paid after 45 days, then what will happen? Then if you pay on the 46th day, whichever year you are making the payment, that year you can claim as deduction. Did you understand or not? Let us see if you understood or not. Let's say A has purchased the goods worth rupees 10 lakhs from B and A is making the payment. Case number 1. The purchase date is 1/4/2025 and payment date is 31/3/2026. Now, has he made the payment within 45 days? Answer is no. Payment is not made within 45 days. Then when is the payment made? It is made on 31/3/2026. That is why the payment will still be allowed in previous year 25-26. You get my point or not? So hence, If you don't make payment within the time limit, then see which year you are making the payment. So the year of payment becomes the year in which the deduction is allowed. If you made it in 25-26, you can claim in 25-26. Now next case, purchase date is 1/4/2025, but payment date is 1/4/2026. Did you make the payment within the time limit as per MSMED Act? Answer is no. So which year you made the payment? The payment is made in 26-27. That is why deduction is allowed in 26-27. Then next case, purchase date is 31/3/2026, but payment date is 10/4/2026. Here the payment has been made in the next year. However, it has been made within the time limit as per the MSMED Act. That is within 15 days itself payment was made. That is why it is allowed in 25-26, not in 26-27. Now let's talk about next case. Section 31/3/2026. The purchase was made. Agreement was there for 60 days and payment was made in 50 days. Payment was made in 50 days. Now what will happen? Payment is made as per agreement, sir. However, even though there is agreement, what did I tell you? Maximum it can be 45 days only. Since it is made after 45 days, that is why in that year it will be allowed as deduction. So since it is made in 20th May 2026, it will be allowed in previous year 26-27. Now is it clear? Now you know how to solve the question. Very good, Kanna. So this is the actual payment basis. Now let us come to section 36, general deduction. General deduction. Now this general deduction are there, no? This is not segregated like how I have segregated here, insurance related, salary related and all. I have only segregated so that it is easier for you to learn. Firstly, let us learn all the insurance related deductions. Firstly, we are going to learn about stock insurance. Stock insurance is only allowed if it is paid by the assessee. If it is not paid, it is not allowed. Here listen Karna, in your study material you will get confused between payment basis. Here payment means payment within the previous year. If stock insurance is paid within the previous year, it is allowed. If it is not paid, it is not allowed. If it is paid in next year, it will be allowed in the next year. Okay, wow. Here there is no concept of due date of filing return of income. That concept is only there in 43B. That is why here, to avoid the confusion, in my material I have given two types of wordings, Karna. One is called payment basis and second is called actual payment basis. So if you see the payment basis word, it means you should understand that the payment has to be made within 31st March 2026 itself. Only then it will be allowed as deduction. But if you see the word called actual payment basis, then you should know that the payment can be made within the due date of filing return of income. Okay, so that you don't get confused, I have given different wordings. So first, what we are learning, stock insurance. So if the assessee is taking insurance on stock, then the premium has to be paid within the previous year itself. It is paid, it will be allowed. If it is not paid, it is not allowed. Now let's talk about employee health insurance premium. Employee health insurance premium is allowed as deduction on payment basis. So within the year itself, it should be paid and it should be paid through any mode other than cash. It should not be paid in cash. Now let's talk about salary related deductions. Firstly, bonus or commission. So if bonus or commission is paid to employee, we have already discussed in section 43B, no, it should be paid on or before the due date of filing return of income as per section 43B. Only then it will be allowed as deduction. Now let's talk about employer contribution to funds. In 43B, we have already discussed that if employer is contributing to the fund, then it is only allowed as deduction if it is paid within the due date of filing return of income as per section 43B. And in section 36, it is given that it is only allowed if it is paid to the approved funds, that is approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund, or any other fund as per law. Okay, so only to the legal funds if you are paying, it will be allowed as deduction. To other unapproved fund and all, it will not be allowed as deduction. Then employer contribution to pension scheme. Employer contribution to pension scheme also is allowed on actual payment basis as per section 43B. Moreover, here there is a limit, Kanna. Employer can contribute maximum how much? Only 14% of salary. And here salary means basic salary plus DA terms. Basic salary plus DA terms. Okay, so up to that maximum 14% only employer can contribute. If employer is contributing higher amount, then only up to 14% will be allowed as deduction. Balance amount will not be allowed as deduction to the employer. Now let's talk about employee contribution. Kanna, employee contribution is not at all an expense. Okay, let's say there is an employer, there is an employee. employer contributes to the fund. Okay, this is called employer contribution. Employer can claim deduction if he is paying within the due date of filing return of income, and if it is to the approved fund, he can claim the deduction. When employee is contributing, then there is no question about deduction at all, because it is an expense which is made by the employee. Then why are we studying employee contribution here? Because generally you know what happens. Employee himself will not contribute. Employer only will be giving salary to this employee. In the salary only, he will cut some portion as employee contribution, and employer only will deposit the employee contribution to the fund. Okay, it can be provident fund, superannuation fund, whatever fund. So employee contribution will also be deposited by the employer only generally. If the employer is not depositing this employee contribution to the fund within the due date as per fund, not return of income kana, due date as per fund, then what will happen, this entire employee contribution, the Income Tax Act will give punishment that this entire employee contribution will be considered as deemed income of the employer. So what did I say? This employer is there, he should contribute employer contribution. That should be contributed within due date of furnishing return of income. It will be allowed as deduction on actual payment basis if the payment is made to a approved fund. Now let's talk about employee contribution. If the employee contribution, that also payment has to be made by employer only. Because what employer will do, when he is giving the salary, he will cut a portion of the salary, and that portion only he will be depositing to the fund as employee contribution. Here the Income Tax Act is very, very strict. When the employer is depositing employee's contribution, he should contribute within the due date as per the fund. If he is not contributing within due date as per fund, then entire amount of employee contribution will be treated as the income of the employer. Okay. So only if it is paid on or before the due date of fund. So due date of employee provident fund is how much? It is 15th of the next month. So if it is paid after the due date, then it is deemed as PGBP income. Now let us talk about other business related deduction. Firstly, interest paid. So if any loan is taken for the purpose of business, then whatever is the interest paid for such loan will be allowed as deduction. So interest on borrowings is allowed only if it is related to business, other than interest added to cost under section 43 subsection 1. What did we learn in 43 subsection 1? We had learned that if the loan is taken to purchase a depreciable asset, then you should add the interest up to the date of put to use to the cost of the asset, and balance interest you can claim as deduction under section 36. Fine. Certain interest we have already discussed, scheduled bank, etc., that can be claimed only on actual payment basis under section 43B. Now let us talk about bad debts. Bad debts means what? Some amount that you were supposed to receive, but the person is not paying you and it is irrecoverable now. Hence, this irrecoverable bad debts can be claimed as deduction. But bad debts can only be claimed as deduction if it was taken into income earlier. For example, you have shown it as sales. Sales is an income. Now that value of sales, if it is credit sales, it will be standing in the sundry creditors. If the sundry creditors is not making you the payment, then it is called bad debts. This bad debts can be claimed as deduction. However, if you have given a loan, then the loan is not your income kanna. That is why when the person is not repaying you the loan, it is a bad debt of loan. Bad debt of loan is not allowed as deduction because earlier loan was not treated as income. Only one person can claim the bad debts of loan as deduction, that is the person who is having money lending business. So if the assessee is having money lending business, then bad debts of loan also can be claimed as deduction. Now, bad debts, to claim it as deduction, you have to take it into income earlier, and also you have to write it off in the books of accounts. It is compulsory that you write off in the books of accounts. But provision for bad and doubtful debts and all not allowed as deduction. Only actual bad debts will be allowed as deduction. Provision will not be allowed as deduction. You get my point? Then let's talk about CTT and STT. Security transaction tax and commodity transaction tax can be claimed as deduction if it is for the purpose of business. But in the capital gain chapter, what did we learn? STT and CTT is not allowed as deduction. In PGBP, it is allowed as deduction. In capital gain, it is not allowed as deduction. Okay, now let's talk about other deductions. Firstly, discount on zero coupon bond. So what is zero coupon bond? Coupon means interest kana. Zero coupon bond means zero interest bond. So what is this zero coupon bond? It means bond will be first issued at discount. Let's say the bond value is 100 rupees. It will be issued at 90 rupees. Issued at 90 rupees, but later on when there is maturity, entire 100 rupees will be paid, but there will not be any interest. So what is the interest? This discount on zero coupon bond is only the interest, that is 10 rupees is the interest. Now how to claim the deduction on discount on zero coupon bond? So to claim the deduction, what you have to do, deduction is equal to maturity price minus issue price. Okay, so here what is the maturity price? 100 rupees minus issue price, that is 90 rupees, divided by number of months. So let's say the bond is for 11 months, so you should divide by number of months, 11 months. So you will get deduction per month kana. Deduction per month. Now in the previous year, how many months are there which is covered in the zero coupon bond that you see, multiplied by number of months. So that many months you multiply, you will get the deduction. So what you have to do, you have to do maturity price minus issue price divided by number of months multiplied by number of months during the previous year of the bond. Okay, now let's talk about promoting family planning expenses. Kanna, family planning is there, no? That will be done by individuals. Okay, husband wife will only do family planning, but expenditure is not allowed to husband wife. Expenditure is allowed to companies only. Expenditure is only allowed to whom? Only company can claim family planning expenditure. So when company is promoting family planning amongst the employees, then the entire expenditure can be claimed as deduction. If it is a revenue expenditure, it is fully allowed as deduction. But if it is a capital expenditure, it will be allowed in 5 equal annual installments. So capital expenditure, 5 equal annual installments. And here for family planning, if at all the profit is not sufficient to absorb the family planning expenditure, it will be called as unabsorbed family planning expenditure. This unabsorbed family planning expenditure is treated the same way as unabsorbed depreciation and unabsorbed scientific research expenditure. So it means what? You can carry forward for unlimited number of years, and after carrying forward also you can set off against any other income other than salary. Okay, so that is the benefit given to family planning expenditure. So these are all section 36 deductions. Now let us talk about section 37, which is residuary expenses. Now Kanna, we have discussed so many deduction, but so many deduction we have not discussed also. That is printing and stationery, travel, conveyance. So many deductions are there which we have not discussed. Does it mean that it is not allowed? Answer is no. Whatever is the any other deduction, if it is related to business, it will be allowed under section 37, that is residuary expenses. So any expense related to business will be allowed as deduction, but you have to satisfy certain condition. What are the condition? The expense should be for the purpose of business or profession. Only then it will be allowed. Then only revenue expenditure is allowed. Capital expenditure not allowed, only revenue expenditure allowed, and only legal expenses allowed Kanna. Illegal expenses not allowed. If it is illegal income, you should add it to the income, but if it is illegal expense, you should not allow it as deduction. Okay, then prior period expense is not allowed. So prior period expense can only be claimed in two places, section 35, that is 3 years prior period, and 35 AD, that is all the prior period you can claim. But in section 37, prior period is not allowed. Even in preliminary expense you are claiming prior period only. Okay, my mistake. Then contingent expense also not allowed as deduction. So I told provision for bad and doubtful debts. Like this, if you are creating any provision, that is not allowed as deduction under PGBP. Only legal expenses allowed, illegal expense not allowed. What is illegal expense? Illegal expense means expense for any offense that is prohibited by law in India or outside India. For example, you are paying a bribe. This bribe you are paying for business purpose only, but it is not allowed as deduction because bribe is not a legal expenditure. Then providing benefit or perquisite to a person where acceptance of such benefit or perquisite is in violation of law. So it might be legal for you, but for the person who is receiving the money it might be illegal. Then also it is not allowed. For example, there is a laboratory. That laboratory is paying referral fees to doctor for referring the laboratory. For doctor, accepting this referral fees or commission is not legal. That is why for laboratory also it will not be allowed as deduction. So when lab is paying referral fees or commission to doctors, or pharma companies are paying freebies to doctors, it is not allowed as deduction, because for the doctors it is not allowed as it is not legal when they are receiving such income. Okay, then compounding fees paid for any offense. So compounding fees, and next one is settlement amount paid in relation to contravention of any law. So you are making any mistake as per law, it is illegal. Now to settle that mistake, you are paying some amount for that authority. That is also considered as illegal expense only. It is not allowed as deduction. For example, you constructed one building. For that you had gotten an approval only for 2000 square feet, but you built 2500 square feet. This extra 500 square feet, no, now you are paying some compounding fees to make this 500 from illegal to legal. Is it allowed as deduction? Answer is no, it is not allowed as deduction. And here there is an amendment also. It is a clarificatory amendment. The amendment is telling, even if the settlement amount was paid as per SEBI Act, that is Security and Exchange Board of India Act, or SCRA, that is Security Contract Regulation Act, or Depository Act, or Competition Act, even then it will not be allowed as deduction. So what did I say? Even if the amount is paid as per SEBI Act or SCRA Act or Depository Act or Competition Act, still it will not be allowed as deduction. So if any amount is paid which is not legal as per law, it will not be allowed as deduction. But you know what? If an amount is paid which is a breach of contract, then it will be allowed as deduction. Breach of law not allowed as deduction, but breach of contract is allowed as deduction. For example, I am doing business with another person and I promised that I will do a delivery within 10 days. If I don't do delivery within 10 days, I will give you a fine of 5,000 rupees. Okay, fine of 5,000 rupees. Now this is my business contract. As per business contract, let's say I was able to do delivery after 12 days only. So I paid him 5,000 rupees as fine. Will this fine be allowed or not allowed? Answer is it will be allowed, because it is only a breach of contract. It is not a breach of law. Breach of law not allowed. Breach of contract is allowed as deduction. Now let us talk about other expenses. Some other expenses that are not allowed, I am going to tell you. First is corporate social responsibility. Kanna, CSR expense is the expense which is made by company for corporate social responsibility. This expense is a compulsory expense for the company. Still, it is not allowed under Income Tax Act. Then advertisement. If the advertisement is made in any souvenir, brochure, pamphlet, newspaper, etc., which is published by a political party, then such advertisement expenditure not allowed as deduction. Then if any dividend is paid, can you claim dividend as expense? Answer is no. Dividend is a distribution of profit, Kanna. It is not an expenditure. Hence dividend is not allowed as deduction. And lastly, any penalty paid to any tax authority. So as per Income Tax Act or as per any act, let's say GST Act also, if you are paying any penalty, that penalty is not allowed as deduction. Now let us see some expenses that are allowed as deduction. So firstly is gift to employees. To encourage the employees, the employer is giving gift. Can this be claimed as deduction? Answer is yes. You are promoting the employees only, no, so that they will be motivated and do work for your business. That is why gift to employees allowed as deduction. You are doing puja. With this puja, you are enhancing the spiritual atmosphere. You are increasing the positivity in your business. So this will be allowed as deduction. So puja expense allowed. Then seminar fees. So I am a chartered accountant. I am attending seminar, etc. This is for the purpose of my profession only. So I can claim the seminar fees as deduction. Then indirect taxes that are not claimed as credit on actual payment basis can be claimed as deduction. So for example, I am purchasing some goods. On this import purchase, I am paying custom duty. This custom duty is not allowed as credit. Can I claim this custom duty as deduction? Answer is yes. Since you are not getting credit, you can claim it as deduction. But you have to make sure that the deduction is on actual payment basis. Now let's talk about all the deductions are over. Now let us talk about inadmissible deduction, Kanna, that is disallowances. So whatever is allowed that we have discussed. Now we are discussing what and all is not allowed as deduction. Firstly, let us talk about section 40 small a series. So 40 subsection A. So first one is payment outside India or within India to a non-resident without deducting a TDS. Or TDS is deducted but it is not paid within the due date of filing return of income. Then entire expenditure is disallowed. So what did I say? If any amount is paid to a non-resident or if it is paid outside India, If TDS is supposed to be deducted, then it is compulsory to deduct the TDS and pay the TDS to the government within the due date of filing return of income. If TDS is paid within due date of filing return of income, then entire amount will be allowed as deduction during the previous year. However, if TDS is paid after the due date of filing return of income, then it will be allowed in that year kanna. Let's say due date of filing return of income is 31st July. So TDS I paid to the government in August month only. Then what will happen? Then next year only I can claim the deduction. Now let us talk about resident. Okay, if payment is made to a resident and if TDS was supposed to be deducted, but TDS is not deducted or deducted but not paid within the due date of filing return of income, then 30% of the expenditure will not be allowed. So when can I claim this 30%? In future, when I actually deposit the TDS, no, after the due date, then I can claim the deduction of 30%. So if TDS is not paid within the due date of filing return of income, 30% of the amount is disallowed. It will be allowed in the year in which the payment is made. Now there is one exception karna. Let's say when I am making the payment, no, I forgot to deduct the TDS, but the opposite person, no, he was a very good person, genuine person. So what did he do? Correctly, he has shown his income in the return of income. He has paid taxes on that income and he has filed the return of income and is giving me the CA certificate that the chartered accountant is telling that this person has correctly shown whatever your payment is there. No, he has correctly shown it in the return of income and paid the tax. So what did I say? The person who is receiving the payment from us, that is resident or non-resident, both it is applicable. The person who is receiving the payment, that is the payee, okay, payee should pay the tax, should show the amount in the return of income, should file the return of income and should give CA certificate. If all these four conditions are satisfied, then in the year in which that person is filing the return of income, in that year you can claim the deduction. Okay, so both above are allowed in the year when the TDS is paid. Also, if the payee has paid the tax, included the amount in total income, filed return of income and gives the CA certificate, the amount so allowed in the year is allowed in the year in which the return of income is filed by the payee. Even if the payee files within due date, let's say the person who is receiving the payment, no, they are filing the return, but they are filing within the due date itself. Now, can you claim in previous year 25-26 or 26-27? Answer is 26-27. If they are filing the return of income, no, then you can't wait till the due date. Whichever year they are filing the return of income, that year it will be allowed as deduction. So still deduction will be allowed to the payer only in the year of filing. So in which year they are filing, that year you can claim the deduction. Now let's talk about salary payable outside India. This provision is very strict provision kanna, because if the person is paying salary outside India or in India to a non-resident, then if the person forgot to deduct the TDS, 100% TDS is disallowed, 100% salary is disallowed, and he has to pay within the TDS due date kanna, not within the return of filing date or due date of filing return of income. The person has to pay the TDS within the due date to pay TDS. If it is not paid within due date, it is not allowed. If it is paid late also, it is not allowed as deduction. If you pay within time, it is allowed. If you don't pay within time, it is never allowed as deduction. What did I say? Salary paid outside India or within India to a non-resident, if TDS is not deducted or if TDS is deducted but not paid within TDS due date, then 100% disallowed. Next, income tax, surcharge, cess or any other tax on PGBP or interest on tax is not allowed as deduction. So income tax is not allowed as deduction under Income Tax Act. Okay, then tax paid on non-monetary perquisite of employee. If the employer is paying the tax on the non-monetary perquisites of employees, then it is not allowed as deduction for employer, and in the hands of employee it will be considered as exempt income. So for employer it is not allowed, for employee it is exempt income. Now let's talk about section 40 B series. So section 40 small b, subsection B, let us discuss first. It talks about interest on capital to partner and remuneration to partner. Interest on capital which is given to partner and remuneration given to partner, it is allowed as deduction but subject to the limits which are given in section 40B. Firstly, let us talk about the limits on interest on capital given to partner. Interest on capital given to partner is allowed only if it is authorized by the partnership deed only if it is after the date on which it is entered in the partnership deed. So in the partnership deed, you can't enter that I will be allowing the interest on capital from previous year onwards. Like that you cannot say. Only after the date of deed it will be allowed, and maximum 12% only allowed. So what did I say? Only if authorized by partnership deed, only if it is after the date of the deed, and only up to 12% will be allowed as deduction. So it is very, very simple. Take the actual interest or partnership deed interest or 12%, whichever is lower will be allowed as deduction. What did I say? Actual interest or partnership deed interest or 12%, whichever is lower will be allowed as deduction. Now let's talk about remuneration paid to partners. So remuneration means what? Salary given to partners. Okay, wow. Salary is allowed only if it is given to working partner. Okay, wow. Salary given to non-working partner, sleeping partner, dormant partner, or sometimes they call them as investing partner, that and all is not allowed as deduction. Only working partner allowed as deduction. Then salary is allowed only if it is authorized by partnership deed. So in the partnership deed, it should be mentioned that this much salary can be given to the partners. Then only if it is after the date of the deed, and only if it is within the limit. What is the limit? Up to 6 lakhs rupees, 3 lakhs or 90%, whichever is higher. So take the book profit, up to 6 lakhs of book profit, 3 lakhs or 90%, whichever is higher will be allowed as deduction. On balance book profit, 60% of book profit will be allowed as deduction. So up to 6 lakh 90%, above 6 lakh 60%. Up to 6 lakh 90%, above 6 lakh 60% will be allowed as deduction. But sir, what if there is a loss? If there is a loss, how much maximum partner salary can be given? Answer is 3 lakhs, because 3 lakhs or 90%, whichever is higher. Okay, wow. So 3 lakhs or 90%, whichever is higher, and on above 6 lakhs it will be 60% of the book profit. Fine. I have given you example also here. If the book profit is loss of 5 lakhs, then maximum partner salary can be given is 3 lakhs. If book profit is 1 lakh rupees, maximum salary is 3 lakhs. If book profit is 6 lakhs, then maximum is 90%. So 5 lakh 40. 540 or 3 lakhs, whichever is higher, that is why 540. And if book profit is 10 lakhs, then maximum salary is 7 lakh 80,000. This you can do calculation and see, you will get the answer. Fine. Now, sir, what is this book profit? What is book profit? Take the net profit as per PGBP head of income karna. So book profit has no relation with net profit as per books of accounts. Books of accounts has no relation with book profit. Okay, wow. Book profit means take the PGBP as per PGBP income. From the PGBP net profit, you reduce the interest on capital, you reduce the depreciation, you reduce the brought forward unabsorbed depreciation, brought forward unabsorbed scientific research expenditure, brought forward unabsorbed family planning expenditure. All this you reduce, then you will finally get the book profit. So what you should do? Take the PGBP net profit. Means what? As per profit and gains of business or profession, what is the income that you have to see? On this income, you can further reduce interest on capital, you reduce depreciation, you reduce unabsorbed depreciation brought forward, you reduce brought forward scientific research expense, you reduce brought forward family planning expenditure. Then whatever amount is remaining, this is only called as book profit. So on this book profit only you have to calculate 60%, 90% as the case may be. Now let us talk about section 40 capital A series. Firstly, related party transaction. So if any payment is made to a related party, then excess payment is not allowed as deduction. Reasonable payment will be allowed as deduction. Sir, who is related party, sir? Related party means spouse, brother, sister, lineal ascendant, lineal descendant. What did I say? Spouse, brother, sister, lineal ascendant, lineal descendant. Then for other than individual, who is the relative? Director, partner or the members will be the relative, and their relatives also will be the relative. So for example, for a company, director and the director's relatives will be the relative. For a partnership firm, partner and their relatives will be the relative. And for AOP, BOI, etc., member and their relative will be the relatives. You get my point? So all these are relatives. Then what is associate? Even associate is covered in this section karna. Associate means concern in which the person or relative is having substantial interest. Substantial interest means 20%. Always it is 20%. 20% or more voting power or 20% or more profit sharing is called substantial interest. So if any relative or any associate, if I am making any payment to a relative or associate, then reasonable payment is allowed as deduction, excess payment not allowed as deduction. So let's say I am making a payment of rent to a relative. Market rate of rent is 60,000, but what rent I am paying is 1 lakh rupees. So 60,000 allowed as deduction, balance 40,000 not allowed as deduction. You get my point? Now let's come to section 40A3. This is also very important. If payment is made above 10,000 to a person in a day, then it should be through prescribed mode. If it is other than prescribed mode, it is not allowed as deduction. What are the prescribed mode? Account pay check, account pay bank draft, electronic clearing system, or other prescribed mode, which is credit card, debit card, NEFT, RTGS, IMPS, net banking, UPI, and Bhim Aadhaar Pay. So all these are prescribed modes of payment. So here also the same example which I took for actual cost, now it will be applicable here. So in a day, if I pay exact 10,000 in cash, will it be allowed? Answer is yes. But if I pay more than 10,000, it is not allowed. Cross check, not allowed. Bearer check, not allowed. Account pay check, allowed. Okay, allowed as deduction. Fine. Now this limit of 10,000, now it will be increased to 35,000 in case of transport expense. So if you are paying the transport expenses to a goods carriage, in that case, instead of 10,000 up to 35,000 also you can pay through other than prescribed modes. And if the payment is made as a retirement benefit to the employee, then you can pay up to 50,000 also. So let's say I am paying gratuity to my employee. That gratuity, can I pay in cash up to 50,000? Answer is yes, I can pay through cash also. You get my point? Now, let's say there is an expenditure. This expenditure now you claimed as deduction on accrual basis. Now in next year when you are making the actual payment, you have made payment of more than 10,000 to a person in a day other than prescribed mode in the next year. So previous year 25-26 you claimed as deduction, but in 26-27 you violated section 40A3 and made the payment through other than prescribed mode. Then what will happen? Then in the next year, the amount that you have paid other than prescribed mode will be considered as deemed income. Deemed income. Okay. Now let us see Rule 6DD Kana. Rule 6DD. What is Rule 6DD? Rule 6DD tells that what are all the places which is not covered under 40A3. It means what? For all these payments, no, I can make any cash payment also, 1 lakh rupees also, 2 lakh rupees also, it will be allowed. So for all these cases, I can make the payment through other than prescribed mode, even more than 10,000 in a day. So what are the exceptions? Number 1, payment is made to government. So I am going and paying my electricity bill to the government. This electricity bill is 20,000 rupees. Can I pay fully in cash? Answer is yes. Because you are paying to the government, no, you can pay in cash, not a problem. Then if you pay to RBI, you can pay. Then to cooperative banks, Primary Agriculture Credit Society, LIC. Then if you are paying to any employee who is posted in a place for 15 days or more where there is no bank or no authorized dealer or money changer, there also you can pay to the employee in cash. Then if you are paying to an agent, and if agent is going to pay in any of these mode, then also you can pay to agent also. Then you can pay to the agent also, it will be allowed. Then payment made through letter of credit is also allowed. Payment made through mail or telegraphic transfer allowed. Payment made directly to the bank account of the payee, that is also allowed. Then bill of exchange is also a valid mode of payment, and book adjustment also is a valid mode of payment. So what is book adjustment Kana? For example, I have to give you 1 lakh rupee. You have to give me 60,000 rupee. So 60,000 we will cancel each other through book adjustment. Balance 40,000 alone I will pay you. So what did I tell? I have to give you 1 lakh, you have to give me 60,000. Now 60 I cancelled and balance 40,000 only I paid you. This type of transaction is called book adjustment. I cancelled 60,000, no, that is only book adjustment. Is it allowed in Income Tax Act? Answer is yes, it is allowed because it is covered in Rule 6DD. Now let's talk about payment made to purchase. So all these products, if you are purchasing directly from the cultivator or producer, then it is fully allowed even if it is made through other than prescribed mode. What are they? Agriculture product, forest produce. So to the farmer, I am directly paying to the farmer and getting the agriculture produce. Is it allowed as deduction? Answer is yes. Then animal husbandry or dairy allowed as deduction. Poultry farming, fish or fish products, horticulture or apiculture, manufacturing in cottage industry without using power. So in all these places, if any payment is made other than prescribed mode also allowed as deduction, but only to cultivator or producer, not to the reseller. Kana, if I am going to Amazon, and in Amazon if I am buying agriculture produce, then can I pay through other than prescribed mode? Answer is no. For Amazon it is not allowed. Only directly if I am purchasing from the farmer, then only it is allowed. Okay, so this is rule 6DD. Last point, payment in a village or town where there is no banking facility. So if there is no banking facility, then you can pay in cash also, not a problem. Fine. So these are all the places which are exception to rule 40A3. This rule 40A3, no kanna, see, it comes in so many places. So all these places you learn only one time and you have to apply in these sections. So you will be sorted. Okay, now let's come to section 40A7. Provision for gratuity is allowed only if it is actually payable. So just like that, provision for gratuity is not allowed as deduction. Actually, if it is going to be paid to the employee, then only it will be allowed as deduction. Then contribution to welfare funds other than those mentioned in section 36 is not allowed as deduction. So it is only allowed to approved superannuation fund, approved gratuity fund, recognized provident fund, statutory provident fund, national pension scheme. Other than this, it is not allowed as deduction. Fine. Now let's come to section 43A, which talks about change in exchange rate of currency. Kana, it is very simple. Let's say you bought a plant and machinery and it is imported plant and machinery. You are buying from another country. Let's say while buying the plant and machinery, you bought for $1,000. $1,000. At that time, the conversion rate was 92 rupees per dollar. But now, while you are actually making the payment to the seller, that time you have paid $1,000, but while making the payment, the conversion rate was 95 rupees per dollar. 95 rupees per dollar. Now what to do? You have paid $3 rupees extra. No, this 3 rupees, what you will do? First, while purchasing the plant and machinery, what entry you will put? 1000 into 92 is equal to 92,000. Will be taken as cost of plant and machinery. Now while making the payment, how much did you pay? 95,000. So what about this 3,000 difference? This 3,000 you add it to the cost. Add to cost. Sir, what if there is a profit in currency? If there is a profit in foreign exchange fluctuation, then you reduce from the cost. So that's what is given here. If an asset is acquired through foreign currency on credit or loan and payment is made late, then the difference in the liability, gain or loss because of the difference in exchange rate shall be adjusted with the block of asset. So if there is a loss, you add it to the cost. If there is a profit, you reduce it from the cost. Now let's come to deemed income. So there are 4 cases of deemed income in PGBP. First is remission or cessation of trading liability. So any amount, if it is received back after claiming it as a loss or expenditure or liability, will be deemed income. For example, I have to make a payment of salary. So salary payable I claimed as deduction 10 lakh rupees. But later on that employee ran away and now I need not pay him any salary at all. So now it is my deemed income. So I have to add it to my income. Okay, then balancing charge. Balancing charge means what? Balancing charge is the profit on sale of the depreciable asset, which we are going to learn in capital gain chapter. There I have discussed what is balancing charge. Then sale of capital asset used for scientific research, that is also deemed income. And then if bad debts, first if it is claimed as expenditure, later on if there is recovery of bad debts, then recovery of bad debt will be treated as income. Now let's talk about presumptive income. So all the deductions are over, all the disallowances are over, deemed income is also over. Now we are discussing about presumptive income presumptive income and audit. First, let us talk about presumptive income, that is section 44ADA, section 44AD and section 44AE. What is presumptive income? Presumptive income is a scheme which is given in the Income Tax Act. If the individual or HUF or any person who is eligible, if they want, they can choose this scheme. If they choose the scheme, they have to show the minimum income as per this section. For example, in 44AD, the presumptive income is given as 6% or 8% of the turnover. So they have to show minimum 6% or 8% of turnover or actual profit, whichever is higher has to be shown. If presumptive income is shown, then the Income Tax Act will give benefit to the assessee. What benefit, sir? The benefit is that the assessee need not maintain any books of accounts. The assessing officer cannot ask for books of accounts from the assessee. Second benefit is that the assessee need not go for audit under section 44AB. Audit will not be compulsory. And the third benefit is that in case of advance tax, instead of 4 installment, there will only be 1 installment. But that benefit is only given to 44ADA and 44AD. Okay, well, so let us see these presumptive income one by one. Firstly, let us talk about section 44AD. To whom it is applicable? To resident individual, HUF and partnership firm other than LLP. It is not applicable to LLP. Other than LLP, resident individual, resident HUF, resident partnership firm only can take the benefit of 44AD. For whom it is eligible? The assessee should be engaged in business kana. Okay, that is selling goods or providing services or manufacturing, whatever business it can be. Condition for eligibility: the turnover should be up to 200 lakhs only. So maximum turnover should be how much? 200 lakhs, that is 2 crores. However, there is an enhanced eligibility also. What is the meaning of enhanced eligibility? That if you are satisfying the condition, then instead of 200 lakhs, even up to 300 lakhs you can take the scheme. So this 2 crores will become 3 crores if you are satisfying the condition. What is the condition? The condition is that aggregate cash receipt should be within 5% of the total turnover or gross receipt. So in the year, how much ever amount is received in cash, no, that should be within 5%. So up to 5% only maximum you should receive cash. Okay, well, 5% of what? Total turnover or total gross receipt, as the case may be. If it is a business, it is turnover. In case of profession or service, it will be gross receipt. Fine. Then check and demand draft, which is not account pay check or not account pay demand draft, will be deemed as cash. So now what do I say? What is the eligibility? So cash plus non-account pay check plus non-account pay bank draft. All the three combined should be up to 5% of turnover. So within the year, how much ever amount is received through cash, non-account pay check, non-account pay bank draft, all the three combined should be within 5% of the turnover or gross receipt. If this condition is satisfied, then instead of 200 lakhs, the limit will be increased to 300 lakhs. So up to 300 lakhs also, the assessee will be eligible to claim the scheme. Now, who are all not eligible to claim section 44AD scheme? First, if you are covered under any other presumptive section, then you cannot come under 44AD. Then, if the person has claimed any deduction under certain income-based deduction, that is section 80JJAA, 80QQB or 80RRB, then such person cannot claim benefit of 44AD. Then, if the person is having commission income or brokerage income, then also it is not allowed. And in case of agency business also it is not allowed. So what did I say? If the person is covered under other presumptive income, not allowed. If the person is claiming certain income based deduction, that is 80JJAA, 80QQB, 80RRB, it is not allowed. Then if a person is claiming deduction under 10AA, that is for special economic zone, for them also not allowed. Then for commission income or brokerage income also not allowed, and agency business also not allowed. So if you see the profit and loss account, in the profit and loss account, if you find some word like commission income or brokerage income, then you should know that you cannot take 44AD scheme. Okay. Now, what is the income that has to be shown, sir? If the amount is received through prescribed mode up to the due date of filing return of income, 6% of such turnover, 8% of balance turnover will be the income. Let me give you an example. Let's say the turnover is 1 crore and 98 lakhs. If turnover is 1 crore 98 lakhs, is the person eligible? Answer is yes, because it is within 200 lakhs, no, so eligible. Now let's say up to due date of filing return of income, the person has received 1 crore 50 lakhs through UPI payment. So since it is received within the due date of filing return of income, you multiply it by 6%. Then received 10 lakh rupees through cash. Cash is not a prescribed mode, so 8%. Received 15 lakhs through bearer check. Bearer check also not a prescribed mode, so 8%. 5 lakh rupees through net banking. Net banking is a prescribed mode, so 6%, and balance 18 lakh rupees is not yet received at all up to the due date of filing return of income. So that is why that also you multiply by 8%. So finally you will get the answer as 12,74,000. 20,74,000 you should compulsorily show it as income, or if your actual profit is even more, then the higher amount you have to show it as income. Fine. Then only you can take the scheme. If you are showing the income as presumptive income, then it is deemed that all the deductions are allowed. So further you cannot claim any deduction. So for example, here if 12,74,000 is shown as presumptive income, can I reduce any expense from this 12,74,000? Answer is no. This 12,74,000 only will be considered as my final profit. Okay, ba? Then WDV of the depreciable asset shall be reduced as if the assessee has claimed the depreciation. So WDV will keep on reducing. Now what is the benefit? If the scheme is chosen, no need to maintain the books of accounts, no need to get them audited under section 44AB. So no books of accounts, no audit. Then additional condition. Now in section 44AD alone, there is this additional condition also. What is the condition? That if scheme is opted once, it should be compulsorily opted for 5 more years. So 1 year if you are taking the 44AD scheme, the next 5 years also it is compulsory to choose the 44AD scheme if the turnover is within the limits. Okay. If in the next 5 years, if any 1 year also, if you want to come out of the scheme or you want to show the profit lower than presumptive income, then what will happen? If within next 5 years, if you are showing the profit lesser than presumptive profit, then for that year, it is compulsory to maintain books of accounts. It is compulsory to get them audited. And for further 5 years also, it is compulsory to get the books of accounts maintained and get them audited. So I'll give you an example. Let's say there is a timeline. Okay, wow. Here 1, 2, 3, 4, 5, then 6. For the previous year, you have taken section 44AD scheme. So for next 5 years also, year 2, year 3, year 4, year 5 and year 6 also, compulsorily you have to choose the 44AD scheme. It means what? Compulsorily you have to show minimum income as the presumptive income, that is 8%, 6%. If you are not showing it, let's say in year 6, no, I decided that I will show profit less than presumptive. Then what will happen? If within 6 years, if you are showing the profit less than presumptive, then in that year, it is compulsory to maintain the books of account as per section 44AA. Also, it is compulsory to get books of account audited as per section 44AB. And for the next 5 years also, that is for years 7, 8, 9, 10, 11 and 12, also it is compulsory to maintain books of accounts and as per 44AA and compulsory to get the books of account audited as per 44AB. So very strict section. What they are telling, that for next 5 years also you have to compulsory take 44AD. If you are not taking 44AD, then that year books of accounts compulsory, tax audit compulsory, and for further 5 years also books of accounts compulsory, tax audit is compulsory. You get my point? So this is given violation. Now in advance tax also there is a benefit karna, that instead of paying 4 installment, it is okay to pay only 1 installment by 15th March of the previous year. Okay, so instead of 4 installment, only 1 installment. So this is 44AD. Now let us talk about section 44ADA. So 44ADA is also allowed only to resident individual, HUF and partnership firm other than limited liability partnership. So who is eligible? Only the person who is having a specified profession under section 44AA subsection 1 is eligible for this presumptive income. So we learnt in 44AA subsection 1, no, legal, medical, accountancy, technical consultancy, authorized representative, okay, film artist, company secretary, interior decoration, only all those professionals can choose section 44ADA. Now, for 44ADA, if you want to opt for the scheme, then the gross receipt should be maximum 50 lakhs. So up to 50 lakhs, you can opt for the scheme. If it is more than 50 lakhs, you cannot choose this scheme. However, here also there is an enhanced eligibility. This 50 lakhs will be seen as 75 lakhs if you satisfy the condition. What is the condition? Your aggregate cash receipt should be within 5% of your total gross receipt. So here also check and DD, which is not account payee, will be deemed as cash. So same condition karna like 44AD. cash plus non-account pay check plus non-account pay bank draft put together should be maximum 5% of gross receipt. If it is within 5% of gross receipt, then instead of 50 lakhs, the eligibility will be increased to 75 lakhs. Up to 75 lakhs also you can take the scheme. Then what is the presumptive income? Here presumptive income is 50%. 50%. So I am a chartered accountant. No, I am a chartered accountant in practice. That is why for me section 44 ADA is only applicable. So when I am choosing the scheme, then I have to show minimum 50% as my profit. If my actual profit is even more, then I have to show the higher profit. Okay. Then here also all deductions are deemed to be allowed. Here also WDV of depreciable asset is deemed to be reduced. Here also if I am choosing the scheme, then no need to maintain the books of accounts, no need to get them audited under section 44AB. Here there is no additional condition karna. This 5 years condition and all is there. No, it is only applicable in 44AD. It is not applicable in 44ADA. Okay. Sir, what if I show profit lesser than the presumptive income? If I show profit lesser than the presumptive income, then it is compulsory to maintain the books of accounts and also compulsory to get them audited. But you know what? In 44AD as well as 44ADA, in both these sections, audit is compulsory only if the income is more than basic exemption limit. Audit is compulsory only if the income is more than basic exemption limit. Fine. And here also I am getting the benefit that for advance tax I can pay only in one installment, that is 15th March of previous year. Now coming to section 44AE. Section 44AE is allowed to any person. So the person can be individual, HUF, AOP, BOI, company, any person. Then the person should be engaged in business of plying, hiring or leasing of goods carriages. So he should be in the transport business. So goods carriage business. One more condition is that the person should be owning not more than 10 goods carriage at any time during the previous year. So during the entire year, not even a single day, he should be having more than 10 goods carriage. Goods carriage means what? The truck, lorry, all these are only goods carriages, tempo, all these goods carriages. Then there are two types of vehicle kanna, not heavy vehicle and heavy vehicle. Not heavy vehicle means gross vehicle weight is up to 12 ton. Heavy vehicle means gross vehicle weight is more than 12 ton. Now what is gross vehicle weight? It means vehicle weight plus load weight. That is only gross vehicle weight. If load is not given, you just take what is the vehicle weight given in the question. If the vehicle weight is up to 12 ton, it is not heavy. If it is more than 12 ton, it is heavy. What is 1 ton? 1 ton is 1000 kg. So 12 ton means 12,000 kg. If it is up to 12,000 kg, it is not heavy. If it is more than 12,000 kg, it means it is heavy. Now, here you have to calculate the presumptive income based on the number of months that the carriage is owned by the assessee. So, month should be, even a part of month is considered in month. Okay, wow. So, month includes part of month. Have I given it already? Yes, part of month is also included in month. You need not write once again. So month means what? The period for which carriage is owned by the assessee. Kanna, in depreciation, what did we discuss? That depreciation is provided only when the asset is used by the assessee, put to use. But here there is no put to use concept. Here ownership concept is there. So even if I am having, but if I am not using, still I have to calculate presumptive income based on that vehicle. Purinjada. So months means the period for which the carriage is owned by the assessee. Fine. Now, how to calculate presumptive income? For heavy goods vehicle, there is one method. For other than heavy good vehicle, there is another method. So for heavy goods vehicle, the presumptive income is 1000 rupees per ton per month. 1000 rupee per ton per month. 1000 rupee per month per ton per month. Here part of a ton also will be considered as 1 ton and part of the month also will be considered as 1 month. Then for other than heavy vehicle, it is 7500 rupee per vehicle per month. 7500 rupee per vehicle per month. Here, sir, how to do the calculation, sir? I will show you this table, Kanna. This is your institute study material question. In institute study material question, the answer which is presented by the institute, that you should not follow. It is a wrong presentation because that will work out only if the heavy vehicle is having the same weight. Okay, in the question if you see both heavy vehicle, the weight is 15 ton only. That is why you are getting correct answer in the institute method. That method you should not follow. Then what method, sir? You please follow method which is given on your screen. So what you should do, put the serial number, then you put what is the date. Okay, then you mention whether it is a heavy vehicle or not heavy vehicle. Then you write number of vehicles. Then based on the date, no, you calculate what is the months. Then you write the number of months. So month and ton. In case of not heavy vehicle, you need not write the ton, because in not heavy vehicle, the calculation is month multiplied by income. Okay, ton is not considered, only income is considered. But in case of heavy vehicle, ton is also considered. So that is why in not heavy vehicle, you need not write the ton. So then income, for heavy vehicle the income is 1000 rupees, then for not heavy vehicle income is 7500 rupees. Then it is very simple, Kanna. You multiply number of vehicles multiplied by month, multiplied by ton, multiplied by income. So 1, 2, 3, 4, all these 4 figures you multiply, you will get the total answer, and you add all of this together, final answer will be your presumptive income. You get my point? So like this you do the calculation. Month 10 vehicle, okay, multiplied by income. Month 10 vehicle multiplied by income for heavy vehicle, and month vehicle multiplied by income for not heavy vehicle. So I have given it here also. 1000 into month vehicle ton, and here 7500 into month vehicle. Like this you have to do the calculation. Finally add all of it together, you will get the total amount. Now here there is one minor difference, Kanna. In 44 AD and section 44 ADA, it is deemed that all the deductions are allowed. However, in section 44 AE, if the assessee is a partnership firm, then in such case the remuneration to partner and interest to the partner is allowed as deduction. What did I say? In 44 AD and 44 ADA, no deduction is allowed. But in 44 AE, if the assessee is a partnership firm, then partner remuneration and interest is allowed as deduction up to 40B limits. So this is an extra deduction that can be claimed by the assessee. Then here also WDV is deemed to be reduced. Then if that scheme is chosen, no need to maintain books of accounts under section 44AA, no need to get them audited as per 44AB. And here, if you show the presumptive income less than the presumptive rate, okay, if the income is shown as less than presumptive income, then it is compulsory to maintain books of accounts and it is compulsory to get them audited. And listen here. Here the income greater than basic exemption limit, this condition is not there. So even if income is within the basic exemption limit, still it is compulsory to get the books of accounts audited under section 44AB. Fine. And here for advance tax, no, the 4 installments only you have to pay. There is no benefit of paying the advance tax in one installment in section 44AE. 44 AD and ADA, you are getting the one installment benefit, but for section 44 AE, there is no one installment benefit. It is 4 installment as usual. So in 44 AE, no, there are 2 major differences, Kanna. First difference is that all deductions are deemed to be allowed, but partner interest and partner remuneration is allowed. So this is one extra benefit that is given. But one benefit is not given, that is advance tax benefit. So these 2 places it is different from the other presumptive section. So I hope you are clear with presumptive income. Now let us talk about section 44AB, which discusses about tax audit. So who should get the tax audit done? If the business is having a turnover of more than 100 lakhs, that is 1 crore, it is compulsory to do the tax audit. So if turnover is more than 1 crore, compulsory tax audit. But here also there is an enhanced eligibility. What is the enhanced eligibility? If you satisfy 2 conditions, if 2 conditions are satisfied, then the 1 crore limit will be increased to 10 crores. So instead of 1 crore, up to 10 crores, no need to do the tax audit. What are the 2 conditions? Aggregate cash receipt should be within 5% of the total receipt. Aggregate cash payment should be within 5% of the total payment. If both conditions are satisfied, then 1 crore limit will become 10 crores. Okay, and this condition, no, it is different from 44 AD and ADA condition. In 44 AD and ADA, we were talking about turnover. Listen here. Here we are talking about 5% of total turnover or total gross receipt. But in 44 AB, it is not turnover, Kana. It is 5% of total receipts and 5% of total payments. Okay, wow. So aggregate cash receipts should be within 5% of total receipt. Aggregate cash payment should be within 5% of total payment. If both conditions are satisfied, then instead of 1 crore, tax audit need not be done if the turnover is up to 10 crores. And here also, check and demand draft that is not account payee will be deemed as cash. Fine. Now what about the other cases? If there is a professional whose gross receipt is more than 50 lakhs, it is compulsory to do tax audit. So in case of business, it is 100 lakhs. In case of profession, it is 50 lakhs. Then if profit is shown lesser than 44 AE deemed income, it is compulsory to do tax audit. Then if profit is shown lesser than 44 AD and 44 ADA deemed income, okay, presumptive income, and if total income is more than basic exemption limit, then it is compulsory to do tax audit. Then if 44 AD is chosen, but you show the profit lesser than presumptive income, then in that year you have to do tax audit, and in the next 5 years also it is compulsory to do the tax audit. Then for whom and all tax audit not applicable. So if a person has shown presumptive income as per 44 AD or 44 ADA or 44 AE, then it is not compulsory to do tax audit. Then audit report. The audit report format is in form 3CA, 3CB and 3CD. Who is the auditor? Chartered accountant is the auditor. So as per income tax, the auditor is the accountant, and accountant means chartered accountant in practice. Fine. Due date. What is the due date to do tax audit? It is 1 month before the due date of filing return of income under section 139 subsection 1. In 139 subsection 1, we see that the due date to file return of income is 31st of October. So what is 1 month prior? It is 30th of September. So for previous year 25-26, the last date to do the tax audit is 30th of September 2026. Then what if books of accounts are not audited? Then what to do? Then there is a penalty. The penalty is given under section 271B. What is that penalty? 0.5% of turnover or gross receipts or 1,50,000, whichever is lower, will be the penalty that has to be paid by the assessee. So 0.5% of turnover or gross receipts or 1,50,000, whichever is lower, will be the penalty. So this is tax audit. Now let's talk about speculative business. Speculative business means what? Speculative business means a business where there is purchase or sale of commodities, including stock or shares, without doing delivery. So I am purchasing some shares and I am selling the shares, but I am not getting the delivery. It means what? I am not interested in the shares. I am only interested in the price differential of the shares. That is why it is called speculation. Example, intraday trading of shares is called speculation business. Why are we learning speculation business separately? Because if you are having a loss in speculation business, that can only be set off against the profit of another speculation business. Okay? With any other business, you cannot set off the loss. And this loss can only be carried forward for 4 years. Generally, you can carry forward loss for 8 years. But in case of speculation, you can only carry forward the loss for 4 years. And there are certain cases which is not considered as speculation karna. It is considered as normal business. What are they? Derivatives, commodity derivatives, future, option, currency future, forward contract, hedging contract. So all these are not speculation. All this is normal business only. Fine. So this is only speculation business. Now let us talk about section 10 clause 1, that is exemption from agriculture income. Agricultural income cannot be taxed under the Income Tax Act. That is why entire agricultural income is exempt from tax. Now what is the meaning of agricultural income? It is given in section 2 clause 1a. So 2 clause 1a tells there are 3 types of agriculture income karna. First is agricultural land, second is income from doing agriculture, and then third one is income from farmhouse. So first is rent from agricultural land, second one is income from agricultural land, and third one is income from farmhouse. So first let us discuss rent from agricultural land. Rent from agricultural land is considered as agricultural income, but only if the land is in India, then the land will be considered as agricultural land. Karna, if agriculture is done outside India, that is not exempt under Income Tax Act. It is fully taxable. Only if agriculture is done in India, it is exempt. Okay, wow. Then ownership is not necessary. So if I take some agricultural land on rent, and this agricultural land, if I give it on rent to some other person, so I am doing the sublease. Then also will my income be exempt income? Answer is yes. So even if I am not the owner, still it will be considered as exempt income. Now let's talk about income from agricultural land. So if I am doing any activity of agriculture, that is also agriculture income. So for example, I am doing ploughing of land. I am sowing the soil, okay, seeds in the soil. So all this is activity of agriculture. By doing this activity, if I am earning any income, it is considered as agricultural income and it is fully exempt under Income Tax Act. Okay, then including nursery also. So listen, nursery is an exceptional case. Nursery, there need not be any agricultural land. Still nursery will be considered as agricultural income. So in exam, if you find a nursery income, it means it is fully agricultural income. Okay, wow? Then process to make the produce fit for the market. So if I am doing any process by which the agricultural produce is being fit to be taken to the market, then such process also will be considered as agricultural income. Then sale of agricultural produce. If I am selling raw agricultural produce, then it is 100% agricultural income. For example, I grew the tomato. This tomato I am selling in the market. So whatever is the income will be considered as pure agricultural income. Then sale after compulsory process to make the produce fit for the market is also 100% agricultural income. Karna, if I am having some produce, but I have to do processing, but without processing I cannot even sell in the market. In such case, even though I do processing, still it will be considered as agricultural income. For example, paddy is there, no? From paddy, you have to remove the chaff. After removing the chaff only, you will get the rice. This rice only you can sell it in the market. Paddy, no one is buying in the market. That is why, if I am doing the processing on the paddy to remove the chaff and getting the rice, then whatever rice I am selling now, this rice is also agricultural income. Fine. Then, however, if doing process is optional and still I am doing the process, then it is a mixture of business income and agricultural income. It is a composite income. For example, I am having tomato. This tomato I can directly sell in the market. So it will be 100% agriculture. But instead of selling tomato, what I do, I make tomato ketchup. I do the processing and I make tomato ketchup using the tomato and I am selling tomato ketchup in the market. In such case, the tomato ketchup has both business income also, agriculture income also. This we have to split up using Rule 7, Rule 7A, Rule 7B or Rule 8. These are the composite income rules. Okay, Rule 7, 7A, 7B and Rule 8. Then income from farmhouse. So what is a farmhouse? Farmhouse means the building which is there in the agricultural land or immediate vicinity of the agricultural land. So it should be either on the boundary of the agricultural land or it should be in the agricultural land. Then it is a farmhouse. Can I put farmhouse on Airbnb and whatever money will I get, will it be agricultural income? Answer is no. Airbnb is not agricultural income. Only if the farmhouse is used as a dwelling for the farmer or for the storage of farm products, then only it is agricultural income. So either the farmer should be living in the house or the house should be used for storage of produce. Then only the income will be agricultural income. Okay. Now let's talk about meaning of agricultural land. What is agricultural land? Agricultural land can be rural land also, urban land also. What is rural land? A rural land means land which is not in urban area. Okay, so what is urban area? Urban area means, let me tell you in the next page. If the population is exactly 10,000, let us take an example of Chennai. The same I have also explained in capital gain revision lecture. But once again I am explaining here also. Let's take Chennai. For example, if population of Chennai is exactly 10,000, then Chennai is urban area. If population of Chennai is more than 10,000 up to 1 lakh rupees, then outside 2 kilometers also is urban area. If population of Chennai is more than 1 lakh up to 10 lakh people, then outside 6 kilometers is also urban area. If population of Chennai is more than 10 lakh people, then outside 8 kilometers is also urban area. If there is any land which is outside the urban area, will be considered as rural land. If agriculture is done on rural land, it will be called as rural agricultural land. But you know what? If it is urban area, just like that you cannot call it as agricultural land. If you want to do agriculture on urban area, then you have to assess the land to land revenue. It means what? You have to possess some government proof that it is an agricultural land, only then it will be considered as agricultural land. So what did I say? Agricultural land can be rural, it can be urban. Rural means what? It is outside urban area, and in rural area if you do agriculture, it will be considered as agricultural land. But in urban area, if you are doing agriculture, just like that you cannot call it as agricultural land. You also have to assess it to land revenue. Only then you can call it as agricultural land. So sitta, patta, sitta, dangal, whatever it is, you have to assess it to land revenue. You have to get a government proof that it is an agricultural land. Only then it will be called a agricultural land. Okay, wa? So urban area means population of 10,000 or more, and it also includes up to 2 kilometers if the population is greater than 10,000, up to above 2 up to 6 if it is greater than 1 lakh, and above 6 up to 8 if the population is greater than 10 lakhs. This population is taken as per the last census, and this 2 kilometer, 6 kilometer, 8 kilometer, no, it is the distance that is aerially measured. Aerially measured distance you have to take. So this is only agricultural land kana. Now let us talk about composite income. I told you some processing has been done by which there is business income also and agricultural income also. Now how to separate the agricultural income and business income? So first is the general rule, that is rule 7. Then we are going to see 3 special rules, that is rule 7a, rule 7b and rule 8. So firstly, general rule. How to separate tomato income and tomato ketchup income? Let us see. Agricultural income, that is income from tomato. How to separate? You take the fair market value of the agricultural produce used for processing. Let's say it is 20 rupees is the value of the tomato, fair market value of tomato. From that you reduce the cost of agriculture produce. So cost of producing the tomato, let's say it is 15 rupees. So if you reduce it, the balance 5 rupees will be considered as agricultural income. Now let's come to the business side. So in business, first you take the sale of final product. So that sale of tomato ketchup, how much I am getting? Let's say I am getting 50 rupees. From this, you reduce the fair market value. So this fair market value which you took, no, the same amount only you have to reduce it here. Fair market value of tomato, you reduce it, and further cost of manufacturing tomato ketchup you reduce. Finally, you will get the business income of tomato ketchup. Like this, you can split the tomato ketchup income into tomato income and ketchup income separately. So here 5 rupees is the tomato income, 20 rupees is the business income. Now let's talk about special rules kana. There are 3 special rules, rule 7a, rule 7b and rule 8. Rule 7a speaks about rubber, rule 7b coffee, rule 8 is tea. So firstly let us talk about rubber. So in rubber, or you can also call it as rubber, latex, crepice or senex. Rubber, latex, crepice or senex. There, what is the ratio? A is to B is equal to 65 is to 35. A is to B, 65-35. What is A? A means agriculture. B means business. Okay, wa? So agriculture is to business is equal to 65 is to 35. Then in case of coffee, you have to see whether the coffee is grown and cured or grown, cured, roasted and grounded. If the coffee is only grown and cured, then the ratio is 75 is to 25. So agriculture 75, business 25. But if the coffee is grown, cured, roasted and grounded, then it is 60-40. 60 agriculture, 40 business, 60-40. Then what about tea? For tea it is always 60-40. So for rubber 65-35, coffee grown and cured 75-25, coffee grown, cured, roasted, grounded 60-40, and for tea also it is 60-40. So this is the composite income rates. Based on this rate, you have to split the income into agriculture income and business income. Agriculture income will be exempt, business income will be taxable. Okay. So now let's talk about partial integration. Before that, let me discuss the other concepts kana. What are the exemptions related to agricultural income? Other exemptions. Firstly, let us talk about section 10 clause 30. Whenever a person who is growing or manufacturing tea in India, then subsidy received from the tea board will be fully exempt. However, there is a condition. The condition is that the subsidy should be used for replantation, replacement of tea bushes, or rejuvenation or consolidation of tea cultivation areas. And then second condition, certificate should be obtained from tea board showing the amount of subsidy and submit this certificate to the assessing officer. If both conditions are satisfied, then the subsidy received from tea board is fully exempt. Then let's come to section 10 clause 31. If the person is engaged in growing or manufacturing rubber, coffee, cardamom or any other notified commodity, then subsidy received from that board will be exempt. And here also conditions are same as the tea bush condition. Okay, so same conditions. If it is satisfied, then the entire subsidy is going to be exempt from tax. Now let us see few examples of agriculture income and non-agriculture income. So rent from land for grazing the cattle is agricultural income. Selling of seed is also agriculture. Selling of flower is also agriculture. Selling creeper is also agriculture. Creeper means the creepers like money plant, etc. That is creeper. Selling bamboo is also agriculture, and income from nursery, I already told you, that is also agriculture. Now, what is not agriculture? Income from milk of cattle, not agriculture. Livestock, not agriculture. Poultry, not agriculture. Dairy farming, not agriculture. Fish is not agriculture. Commission received on agricultural income is also not agriculture. Forest produce like timber, that is not agriculture. And lastly, if a company is doing agriculture and such company is giving dividend, that dividend income is also not agricultural income. Okay, when company is giving dividend, it is not agricultural income. Now let us talk about partial integration of agricultural income with non-agricultural income. Kanna, when a assessee is earning both agricultural income as well as non-agricultural income, then the Income Tax Act will not give the benefit of the lower tax slab to that assessee. This is only called partial integration. So how to do partial integration? Firstly, you have to see if three conditions are satisfied. If three conditions are satisfied, then partial integration will be applicable. What are they? Agriculture income should be greater than 5,000. Non-agriculture income should be greater than basic exemption limit, and it is only applicable to the assessee enjoying the benefit of basic exemption limit, that is individual HUF, AOP, BOI or AJP. If these three conditions are satisfied, then partial integration is applicable. How to do partial integration, sir? You have to follow these steps. Step number 1, compute the tax on agricultural income and non-agricultural income. Step number 2, compute the tax on agricultural income plus basic exemption limit. Step number 3, do step 1 minus step 2. This is only the final tax that has to be paid, and then you add the surcharge and health and education cess as it is applicable. Okay, so what you have to do? First calculate tax on agriculture plus non-agriculture. Then you calculate the tax on agriculture plus basic exemption limit. Then you do step 1 minus step 2 and then add surcharge and health and education cess as usual. There is one question in your first chapter relating to partial integration. If possible, solve that question. Your concept will be clear. Very, very simple only. But you have to remember all these steps. Then only you will be able to solve in the examination. Fine. With this, all the concepts of profit and gains of business or profession is complete. I hope you are clear with all the different adjustments, and you are going to definitely score full marks in the examination. So wish you the best of luck for the CA examinations, and I definitely know that you are going to rock, and after passing I want a message from you saying that you have crossed the side and gone to the next level. Okay, Kanna? See you in the next one. Till then, take care. Bye bye.